meet a higher burden of proof for a supervisory conclusion, and I need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
so you disagree with Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in the day.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift.
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well.
So what
I had no part in, I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're, as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired.
The gentlelady's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell.
As Republican Andrew Garbarino of New York begins his questioning of Fed Chair Powell, we'll check the markets for you. The S&P right now is down 22 points or 0.5%. The Dow is down 77 points. That's a 0.2% decline. The NASDAQ is lower by 1.1%, down 153 points. This is Bloomberg Radio.
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right. Were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. The issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is a capital issue.
So they had too low a capital, the requirements. So what
they weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember what people were focusing on was these portfolio losses, and then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
how much then? Increasing it by how much would have helped?
It's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was just not. It was not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
So last year you said the banking system is very strong, well capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today you said the banking sector seems to be strong. Do you still stand by those statements? I mean, just said it today.
Yes.
So, yep. Last month, Vice Chair Barr appeared before this committee, and he agreed with you. He said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But today, you know, even though you've all said that banks seem to have strong capital, you seem to lead us today by saying the bank's considering what increase would be appropriate of capital requirements. So has the board already decided that an increase will happen? They're just deciding what's the size of the increase for capital requirements?
No, what I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand, and you have a vote as whether or not what this proposal, you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think?
That an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end and give it my best assessment. And also, I'll, you know, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is, you know, agreed and among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on lending, raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month, and expressed my concerns about what the impact of increased capital on the real economy, but he didn't answer the question directly. We just need to, we're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Welcome,
It's
Mr.
Democratic
Chairman.
Congressman Emmanuel Cleaver
This is
of
probably
Missouri.
Economics 101, but a lot of people in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below 4% for the longest stretch in 50 years. In the U.S., the job openings rate has fallen by more than 1.5 percentage points from its peak, while the unemployment rate has crept slightly lower. In other words, the job openings decline, but so does joblessness. And I'm wondering if there was any expectation that this would occur.
There is an expectation that the level of the ratio of job openings to unemployed people has been in historic territory, all-time highs for a while now, in the last year or so. And there is an expectation that it will come down. There a while ago, there were 2 jobs for every unemployed person. Now we're down to 1.7, I believe, or 1.6. And that still speaks to a historically tight labor market, where their demand for labor still very substantially exceeds the supply of available workers. So we do expect as things, and that, by the way, that's a way that the labor market can become less tight without having unemployment go up.
I'm sure you're hearing this all over as I am, and that is business people. I've got a good friend who has a number of barbecue restaurants in Kansas City, and he is constantly telling me how difficult it is to find workers, to the point where he did something he thought I'd never do, put a sign out in front of his restaurants, job openings. And are there particular industries or sectors of the economy where we would expect this sentiment to be particularly true?
No, and that is right. That is, there's still a significant labor shortage. The surveys at the aggregate level show that it's not as bad as it was 2 years ago. So gradually, businesses are reporting that they're having better able to find workers. Workers are reporting that they're not quitting their jobs as much as they were. That's a really good sign of how tight a labor market is how much people feel free to quit their jobs voluntarily. So those things are all suggesting a gradual cooling and a gradually getting supply and demand back into alignment, but we're not there yet. We still have a significant excess of demand over supply.
Are we also finding that I know in Missouri, that in spite of the fact that there is some, jelly-like movement with the economy, people are still willing to go, in our community, still willing to go out and buy homes. I mean, we're not having difficulty in terms of people going out getting loans, even with the interest rates rising. If all of this continues, if the consumers are constantly paying whatever the interest rates might be, are we going to get stuck just continually going up?
Well, no, I don't think so. So in housing in particular, there is the housing sector nationally has flattened out and maybe ticked up a little bit, but at a much lower level from where it was, with rates as high as they are. So supply and demand there are getting back into alignment. And I do think that housing inflation is set to come down as we move forward. There's a particular way that the inflation is calculated there, so that you're really only looking at you're waiting for leases to come due and roll over at much lower levels of increase. So we think housing inflation will be coming down significantly over the course of the rest of this year and next year.
Thank you, Mr. Chairman.
Gentleman's time has expired. The gentlewoman from California, Ms. Kim, is recognized.
Thank you for recognizing me, Chairman.
This is
and
California
Chairman Powell, thank you for
Republican,
joining
Young
us.
Kim.
I appreciate your comment to price stability and commend your efforts to reduce inflation and make life more affordable for all Americans. Thank you for that. The 10,000 small businesses survey of 2,000 small businesses found that 77% were concerned about their ability to access capital. So with that in mind, do you think it's appropriate for the Federal Reserve to increase capital requirements at this time? And I know this was discussed earlier, but what specific analysis has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess that balance. Obviously, the answer is not zero capital, and it's not 100% capital, so it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work from home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
We're very focused on the commercial real estate situation. You're right, of course, that a good portion of the commercial real estate loans are held in smaller banks. And supervisors are very much engaged with those banks. And it's particularly banks that have a high concentration. That's what we look for among the smaller banks. And there are some of those, but there's a playbook for working your way, working your way out of these loans. And it's particularly in the office sector where, work from home is still a pretty material factor in some areas, as you know.
Thank you. So the next question has to do with the board process and procedures. What are those procedures that govern consideration and potential adoption of matters like the proposals that Vice Chair Barr is, about to present to the board?
So on regulation, as opposed to supervision, on regulation, the Board of Governors votes on regulatory proposals, and it's a majority vote. We now have 6 voters, so when there is a proposal, it will be briefed carefully, and then we will have we'll have a meeting, or it can be done actually virtually, and probably will be that way, as most of our meetings are, and then we have a vote. On supervision, it's different. Most supervisory matters are really under the authority of the Vice Chair for Supervision under the law. So most of them don't have to go to the board for a vote.
So what percentage of the governors must vote in favor?
Majority.
The majority of them? Okay. Yeah. The California governor, prior to the depositor bailout for SVB, reportedly identified that he had been in touch with the highest levels of leadership at the White House and the Treasury. The governor also on Sunday, March 12, when the bailout was announced, issued his own statement praising that action. There have also been reports that the governor and his wife, with respect to their business and perhaps other interests, may have had depository interest in SVB. So when the Federal Reserve Board, the FDIC Board, and Secretary Yellen, in consultation with the president, recommended invoking the systemic risk exception for SVB, and then decided to provide blanket insurance even on uninsured balances, did the Fed or any others, to your knowledge, perform any conflict of interest due diligence?
No, I mean, we were in an emergency situation on Monday morning that was going to be, and there was a run on banks that looked, that
So
had
looking
high
back,
insured
do you think
depositors.
there was
We carried out our
Yeah.
duties, and I'm actually pretty sure we did the right thing.
And you don't think there was any conflict of interest, even looking
I
back?
have nothing. I have absolutely no knowledge on that.
Okay. Well, thank you. Thanks for being here. I yield back the balance of my time.
Gentlelady yields back. The gentleman from Texas, Mr. Gonzalez, is recognized.
Thank you, Mr. Chairman and Ranking Member. Thank you, Chairman, for being here with us this morning.
Democrat Vicente
the June Federal
Gonzalez
Open
of
Market
Texas.
Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC that has the proposed interest rate increases up until June 14th recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take, on average, 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policies impacted the strength of the U.S. dollar and how it is valued globally?
Let me say that there's a lot of uncertainty around how long it takes monetary policy to affect real activity. There's no agreement on 42 months or any particular thing, and I think most people would say shorter than that. So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just to us, it's a financial condition. A stronger dollar means certain things, and a weaker dollar means certain other things. But
it continues to be a concern here in this committee. Also, Chairman, as you're aware, the Federal Reserve's core mission is to keep employment up and inflation down. Although I understand the calls for climate-related financial risk management from my colleagues, we should be focusing on the economic state of our country. The credit of the U.S. dollar is at jeopardy, and as you know, we've had global pressure recently, and we need to be sending a clear message that the world can rely on the global economy. With that said, would you agree that monetary policies to directly address climate change should be made by Congress and not the Federal Reserve, and implementing monetary policies and supervisory tools to exclude energy leaders from capital and financial institutions would have a grave impact on local, state, federal, and even global economies?
A strong agreement around the fact that we have quite a narrow role in climate change, and really the important decisions about climate change need to be made by elected people, not by the Fed.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida, Mr. Donalds, is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Really appreciate you being here.
As Florida Republican Byron Donalds begins his questioning of
say,
Fed Chair
first of all,
Powell,
it's good to
the
hear
House
from the
Financial
other side of the
Services
aisle
Committee.
that the
We'll check the
Federal
markets
Reserve should
for
not
you.
be
S&P
engaging
500 right now is
in
down
using its
20
tools
points. That's a
with respect
decline
to
of a half of
climate change or
1%. The
climate
Dow
mitigation or
is
whatever the
little
case might
change to
be.
the downside. It's down
The
19
Fed,
points.
you
The
guys have a big enough
NASDAQ
job
is
as
lower
is.
by 167
Adding
points. That is a
anything
drop
like
of
that
almost
to
1
your
1/4%.
job, I think would be
10-year Treasury is
will
down
be
10
wholly
30 seconds. The
detrimental
yield
to the American
3.76%.
economy.
You're listening
So
to Bloomberg
I, for
Radio.
one, this morning, am glad to hear that coming from the other side of the aisle. You've had a couple questions already on capital, bank capital, et cetera. Look, some of the current views are that continuous raises of bank capital will increase costs to our economy anywhere from $50 to $200 billion. What's your view of the current desire or mode of Vice Chair Barr to fully implement the Basel III capital standards?
Well, I think that's the next thing. Vice Chair Quarles was working on that. It didn't get completed for various reasons, but I think that's an international capital standard that we should go ahead and complete. As to the right level of capital, that's a discussion we're about to have.
Are you guys at the Fed? Are you guys kind of concerned about the fact that now it seems like the European regulators are starting to pull back from that? Like they're starting to think about capital standards being too much for European banks, and that they're starting to recede from what was, I assume, kind of a handshake agreement in years gone by.
Yeah, I'm not hearing that exactly. We'll be watching that carefully, though.
Okay. Overall, just with respect to capital, let's take a step back. Obviously, since 2008, 2009, we have, in my view, aggressively gone through this process of increasing capital standards and capital requirements on a Tier 1 capital for banks. In retrospect, do you think that's been a net positive to the overall banking environment, or do you believe it's been a negative to the overall banking environment?
I think it's been a net positive, and as I pointed out earlier, U.S. banks have competed very, very successfully through this period, despite what were pretty significant capital increases that we put in a few years back. So it really has led to a very strong, and also made it well through the pandemic period, I thought, and I think that was a pretty good test. So even though the government did do a lot to support the economy, still, I think that those capital hikes that we made in the last cycle come through looking pretty good.
Do you guys at the Fed, do you have a view of, I say you guys because I know you're the chairman, but there's other members as well. Do you have a view of the concern about community banking in the United States, or a lack thereof of community banking? It has been shrinking quite significantly over the past 10 to 12 years.
Very, very much so. It's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now. So it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we do.
Do you think that federal regulatory policy, in part from Congress, has led to a supercharging effect of diminished community banking in the United States?
It's probably been a factor, but I do think there have been important demographic factors as well. And also having interstate banking. Interstate banking only became legal quite recently, and that also has led to consolidation. You can look back, though, again, look back 30-plus years, and you've seen a very steady decline. So I think there are demographic and other factors driving it. But, regulation can fall as a fixed cost, which means that institutions need to be bigger. And I think that's probably part of the story.
Look, I don't disagree with your conclusion. I'm just concerned about the trajectory. I think just having larger financial institutions, larger banks overall with a diminishing smaller community bank infrastructure is detrimental to lending to small businesses, mom and pop businesses. It also could be parochial. I started my career in community banking, so I saw a heartfelt situation. Last question, running out of time. The SEC has proposed a rule that would, among other things, require banks to segregate client cash held in custody, upending custody bank balance sheets, and by extension, the bank custody model. Are you guys at the Fed concerned about this proposed rule from the SEC?
The gentleman's time has expired. The chairman can
I'll respond to
in
that.
writing.
Okay, fair enough. Thank you, Mr. Chairman.
The gentleman from New York, Mr. Torres, is now recognized.
Thank you, Mr. Chair, and thank you, Chairman Powell.
This is New York Democrat.
As you know, the
Richie
U.S.
Torres.
has foreign adversaries, particularly the CCP, that seem intent on de-dollarization. How seriously should the threat of de-dollarization be taken, in your view?
Well, the status of the United States, of the dollar as the world's reserve currency, is a very important thing to us. I think the reason we have that status is largely due to our great democratic institutions, the rule of law, and the fact that we have, generally speaking, had strong levels of price stability. And I think that the dollar will remain the reserve currency as long as those things are in place.
Well, I want to explore that answer, because commentators often speak of the dollar as the world's reserve currency as the cause of America's economic dominance. Do you think of it as the cause of America's economic dominance or as a consequence of it?
To me, it's more of a consequence. And also, there tends to be an equilibrium where one currency becomes the accepted global standard, and that has been the dollar for some time, and I expect that it will be for some time, continue to be.
It's often said that the Fed has a dual mandate of maximum employment and price stability. Do you view these mandates as equally binding upon the Fed, or does one supersede the other?
They are perfectly equal under the law.
And I'm curious to know what it means in practice to have a 2% inflation target. The latest pause notwithstanding, does it mean the Federal Reserve will continue raising interest rates until the 2% target is reached, even if doing so comes at the expense of maximum employment as well as financial stability?
No, it doesn't mean that. It does not. So the way we think about it is most of the time the two goals are aligned in the sense that if you're achieving one, you're achieving the other, and if you're a little bit off, the other one, they move in the same direction. Today's situation is unusual in that we are overachieving, in effect, the maximum employment goal, but we are far from achieving the inflation goal. So in our system, we have a constitutional document, and what it says is that when that's the case, you look at how far you are from the goal, and you look at the speed with which you would move back to the goal. And so that would tell you today that we should focus heavily on inflation. But as it becomes closer, as the two things become more aligned, then they go back into perfect equality under the law.
So the Fed engages in a delicate balancing act between employment and inflation.
Yes.
To what extent do you factor in financial stability, safety, and soundness when raising interest rates?
So you're right. We do have a financial stability mandate, but we try to.
Well, you have a financial stability mandate with respect to your role as a bank regulator. But when it comes to
also just generally, we're the lender of last resort. Central banks were originally created to support the financial system in times of stress and to make sure that you don't get into times of stress. So I would say that. Sorry, what was your question before that? It was
to what extent do you factor in safety and soundness when setting interest rates?
Sorry, so we really try hard to use our financial stability tools for financial stability purposes and our monetary policy tools for monetary purposes. The reality on the ground is much messier than that. They're very much entangled, and one affects the other. So the separation is not at all perfect. But we do think of these as separate things with separate tools.
Do you think that the Silicon Valley bank failure revealed a deeper tension between the safety and soundness mandate of the Fed as a bank regulator and the the mandate of the Fed as a administrator of monetary policy?
I would say no, and I'll tell you why. Interest rate risk is, one of the most basic banking risks. We supervise for it. Overwhelmingly, U.S. banks did manage their interest rate risk. Silicon Valley Bank didn't, and even though we were, the supervisors were pointing that out to them, they just didn't take, the bank didn't take action quickly enough. So I would have thought that you can say that it was interest rate hikes that caused portfolio losses, but it was management that failed to hedge against those losses and failed to hold appropriate liquidity.
In the pre-COVID world, we had the best of both worlds: low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or are high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum employment. What will be the level of interest rates there? That's a really good question. And
do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know. It's a great question. We talk about this a lot. The people who argue that they will move it back down just point to the fact that it was really global factors that drove rates down in the first place. Maybe the truth is somewhere in the middle.
Gentleman's time has expired. The gentleman from Nebraska, Mr. Flood, is recognized.
Thank you, Mr. Chairman. Chairman Powell, I'd like to discuss the continued efforts to unwind years and years of quantitative easing and what
this
it's
is
done to our
Nebraska
Federal Reserve
Republican
balance
Mike
sheet.
Flood.
If you take a look at the size of the Federal Reserve's balance sheet since the 2008 financial crisis, we've seen an alarming increase from around $800 million to today's $8.3 trillion in assets. Back in 2018, you did start the work of winding down the balance sheet. You managed to offload roughly $700 billion assets between the beginning of your time as Federal Reserve Chair and August of 2019. The problem was, shortly after your efforts began, we had another major economic shock, the COVID-19 pandemic, that caused the Fed to once again return to quantitative easing as a form of economic relief. Pretty soon, the Federal Reserve's balance sheet had increased another $4 trillion in size. That's how we made it to the balance sheet level that we are at today. I understand you have started working to shed some of the Federal Reserve's balance sheet, and I appreciate the work. That being said, the scale involved here, to me, is startling. My concern, Chairman Powell, is that efforts to shed assets from the Fed's balance sheet have never been anywhere as quick as efforts to build it back up. Our economic cycle does go through recessions from time to time. It's not always boom, but some bust too. If we continue a pattern of rapidly building up the Federal Reserve's balance sheet in bad times and slowly shedding assets in good times, we're going to see the balance sheet grow significantly over time. Chairman Powell, is this a concern of yours? And to pair with that question, long-term, how can we avoid an environment where any effort to unwind the Federal Reserve's balance sheet is undone anytime there's an economic shock?
It is a concern, and that's why we are this time the balance sheet roll-off is much faster than it was back in the first episode. We also know more. We hadn't grown our balance sheet like that, and we hadn't shrunk it before. Now we have experience with that. So we are moving back down to a level that will be appropriate for our new framework. By the way, we won't go back to a framework where we were dealing with scarce reserves. We like the administrative rate framework that we're in now. But it is important that the balance sheet not just grow with every cycle, and I think I'm very conscious of that.
Chairman Powell, do you have an optimal Fed target for the size of what the balance sheet should look like? A number?
I'll give you the idea, and that is you find the number, but the idea is that it's smaller than now. It's a place where reserves are abundant, and also have a little bit of a buffer on top of that so that we don't accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a percent of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve would disrupt our markets?
So we don't sell assets. What we do is we allow them to mature and passively roll off. And that's what we're doing to the tune of about $1 trillion a year. And we're in the middle of that process. Now we will, it's an empirical question. You're going to find a level that is still ample, plus a bit of a buffer. And that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Mr. Horsford, or Nevada, Mr. Horsford is recognized.
I thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today.
This
Before
Nevada
I begin,
Democrat
I'd like to
Stephen
ask,
Horsford.
Permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price stability. There is no doubt that it is difficult, and the needle that has to be threaded is very specific. However, the human cost is simply too great for us to get this wrong. Sometimes we need to be reminded that there are real people behind the economic data and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. Everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them, which is why I was pleased that last week the Federal Reserve decided to pause your interest rate hikes and take stock of the overall economic picture. Now, don't get me wrong, there's certainly more work ahead of us, but with 13 million jobs added since President Biden took office, we should be rooting for America to succeed and not to fail. The strength of the labor market continues despite the multiple concurrent shocks that continue to reverberate throughout the global economy. And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden. These beneficiaries of these investments were the people, the middle class, not special interest. The bipartisan infrastructure law is creating construction jobs and projects that will help ease supply chain challenges and ensure safer transportation for everyone. President Biden and congressional Democrats are investing in technology that will define the 21st century, components to generate solar and wind energy, semiconductors and electric vehicles that will all be made here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing. These are good-paying jobs, union jobs, that are expanding our production capacity here at home while reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities. But this does not mean that everything is improving equally. I've heard time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So, Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a house provides. While higher rates have cooled some housing markets across the country, what do you see as the biggest remaining upward pressure on housing services, and what can we do in Congress to incentivize new home starts to hopefully moderate the imbalance between supply and demand in the housing market?
I think you're talking about largely longer run factors here, and I think there has been for some time a shortage of housing. It's harder to get lots, it's harder to get workers, and in the pandemic it had been harder to get materials and things like that. So there's certainly a need for more housing. I think during the pandemic you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases for housing, and now that is flattened out a lot as we've raised rates. And
Gentleman's time has expired. The gentleman from New York, Mr. Lawler.
Thank you, Mr. Chairman. Chairman Powell, you, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized.
It's Republican
Bank
Mike Lawler of New
capitalization
York.
remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points, based on the Basel Committee literature. On January 21st, 2021, 30-year fixed-rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed-rate mortgage. For the median home, valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson Valley. Now, further decreasing the availability of credit to households and businesses across the country would only likely worsen this crisis. So, Chairman, do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans, and effects would begin immediately, independent of any proposed phase in timing?
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point, and I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very, very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics, but until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board sometime this summer, and the board will vote on that, and we'll obviously share whatever analysis we have.
Are you concerned that any significant increase in capital could significantly jeopardize the Fed's efforts to rein in inflation?
So the thing about capital requirements is there would be a 90-day comment period, roughly, something like that, could be in that that range. And then there would be a long period of considering those, the comments that are made. And then there would be movement toward coming to an agreement about what to finalize. And after that, so that would take many months. And then you would be into a situation where there would be long phase-ins. So I don't really think capital requirements play into the near-term economic situation the way interest rate hikes do.
Chairman, according to the Bureau of Labor Statistics CPI inflation calculator, it takes $1.16 today to buy the same consumer goods and services as $1 purchased when President Biden took office in January of 21. Do you agree that outsized inflation we have seen since early 2021 has caused and continues to harm workers, retirees, and families trying to make ends meet and pay their bills?
I strongly agree with that, and that's why we are taking the measures we're taking.
Thank you.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Nichols, recognized.
All right. Thanks, Chair Powell, for being here with us today. Back in
As North Carolina Democrat Wiley Nickel begins his questioning of Fed Chair Powell, look at the markets now. The S&P 500 is down 20 points. The Dow is up 4. NASDAQ's lower by 178 points, a decline of 1.3%. The 10-year Treasury is down 14 seconds, yield 3.77%. Bitcoin is trading at a 2-month high, up 6.2%, close to 30,000. This is Bloomberg Radio.
I was excited to see that from public reporting that you were at the most recent Dead and Company show. I've been to this version with John Mayer and enjoyed it, but we weren't here. How was the show? Did you like it?
No, it was terrific. What can I say? So it was great. I've been a Grateful Dead fan for 50 years. So,
well, I've found one universal truth that I like people who like the Grateful Dead. So having said that, I have limited time. But do you want any time to go back to some of the questions that you had? Do you want to elaborate on anything that you've said here so far today?
You're very kind to offer, but I'm fine with the answers I've given so far, I believe.
Good. Well, back to that show. A lot of people there in Virginia, and like my constituents, they're very concerned about this economy. They're worried about the cost of groceries, rising inflation, interest rates going up, and when we do these hearings, it's always big news. The things you say, move markets and are very important. But Fed speak is just so hard for my constituents and the American people to understand. What can you tell the American people who are concerned about the economy in a way that they can really understand where this economy really is heading?
So I guess I would say this economy is very strong, and what's driving it now is just a very strong labor market. There's still significant demand for workers. There are more job openings than there are unemployed people. Wages are moving up, and that's really what's driving the economy forward. People's disposable incomes are coming up. Inflation is moving down gradually. The thing that troubles people, and I think the thing that accounts for the surveys you see where despite a historically strong labor market, people are still concerned about the economy, it's really inflation. So this is our job, is to bring inflation down. The way we do it is by raising interest rates. And while that can be painful, what it does is it gradually slows down demand so that supply and demand can get back into alignment, and so that we can have inflation running at 2% and people can get on with their lives and basically not have to think about inflation. That's what the definition of price stability from one standpoint is, just that people can live their daily lives without thinking about inflation all the time. We want to get back to that place. And we're on a journey to get there. We have quite a ways to go, but we're making progress.
And I've always wondered this, and I think there's a pretty simple answer, but if Congress was in charge of setting interest rates and it became a political thing, do you think that's something that we could handle as a legislative body?
I wouldn't want to comment on that.
That's a safe answer. All right. And I do want to just join on the chorus with a lot of my colleagues on both sides of the aisle here about capital requirements for banks. I brought this issue up with Vice Chair Barr, with Mickey Bowman, and in your written questions for the last time you were here, I didn't get a chance to ask questions because my seniority here on the committee, but you said, you answered in writing, and you said, we've got to be mindful of the trade-offs associated with adjusting capital levels as it could, quote unquote, cause banks to reduce the availability of credit or to pass higher costs of credit on to consumers, end quote. And you also said that, quote, capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs, end quote. You know, my constituents sent me here to lower costs for working families, so increasing borrowing costs really hits them hard. As the Fed considers new capital requirements, how do you intend to strike that balance between the trade-off that you talked about in your written response?
So that is the balance. You said it very well. So stronger capital requirements mean we have a stronger banking system, means it's more resilient to downturns and crises and things like that, so banks can continue to lend during even stressful times. And so that's very important, and we put a high value on that. And yet, of course, we know that at the margin, the cost of capital goes up for banks, and the cost of credit will go up. So it's a balancing thing, and there isn't any one simple model or answer. So you just have to make a judgment call based on that, and that's what we'll be doing as these proposals are made and then assessed.
Thank you. I yield back.
Thank you, Mr. Nichols. I look forward to joining you at the next concert with the chairman. We'll see how that works out. Chairman Powell, thank you very much for taking time to be with us here today. Recognize, first of all, that you get, I think politely said, feedback from every sector on how you're doing your job. You are charged with two mandates. Primarily among those are price stability and combating unemployment. As my colleagues have discussed today, the labor market is clearly very tight, and you should be credited with succeeding in maximum employment and being a partner in this. Unfortunately, as we've also heard, and as the country is experiencing, we haven't collectively been as lucky in terms of price stability. Core CPI is still over 4%, and services and housing costs remain very sticky. Given the economic uncertainty on how the Fed will bring inflation to its 2% mandate, can you quickly touch on how the bank capital requirements Vice Chair Barr is proposing? And I'll be specific here. My Main Street businesses, especially farmers, family farms, and Iowans back in my district really provide a backbone on this, and they depend heavily in this area. Do you think that they will be facing a more difficult and expensive credit environment as a result of this?
It's Republican Congressman Zach
I don't
Nunn
think
of
so,
Iowa.
particularly in the near term. So, first of all, many of those people will be dealing with regional and community banks,
right,
rather than with the GSIBs. But even with the GSIBs, though, as I mentioned, the phase-in for higher capital, the process of publishing and then getting comments and evaluating those comments, and then coming to a broad agreement and consensus on what to implement and over what time period, that takes time. And so it will not be important during this period of the next year or two when we're getting inflation back down to target and the economy's kind of normalizing. I don't think the capital the capital changes will have much of an effect in the near term.
So, Mr. Chairman, let me ensure that I'm hearing you correctly. Then, Vice Chair Barr is engaging with small businesses throughout the Midwest right now on potential knock-on effects from this holistic review. Some economic studies have found that these knock-on effects will increase borrowing between $50 and $200 billion. As we look to cut this in half, is this the right thing to be doing?
Sorry, cut in half.
The inflation rate.
Honestly, I don't think the two are really in conflict. We have an obligation to bring inflation back down to 2% over time, and we will do that, and we'll use our tools to do that. But I think the question of bank capital is real. I don't see it as a key factor in how we think about inflation, because again, it'll take quite a while to decide what to do and then to implement. Some of the changes we're talking about will have multiple year phase-in periods.
So, Mr. Chair, let me ask you on that implementation timeline, particularly for new capital standards. You said it would be some years before it would go into effect. According to a report published last year by the Federal Reserve Bank of Cleveland, in the case of implementation Basel III, banks began to increase their capital ratios, and I quote, prior to the publication of specific language applicable to U.S. banks, end quote. And that bank responses, we estimate, to take place well before Basel III rules started to come into force after 2014. Do you agree with the Cleveland Fed, and do you believe that our banks will begin to adjust as soon as the proposal is released?
Yes, I do. It's not an absolute thing where they'll wait until the effective date. They will certainly, and they may even be starting, but I would think the earlier you start, the more gradual the path will be.
Very quickly, I want to turn to a different subject. It's been brought up by a number of my banks back home relating to a central bank digital currency or any federal issued coin. We have seen how this administration and the last Congress wanted to require anyone who made more than $600 on a third-party settlement organization like an eBay purchase has to report that to the IRS. The existing threshold before the law was modified was $20,000. That is how far this administration wants to peek behind the curtain of what my constituents are spending their money on. And $600 in Iowa doesn't go a long way. It's the equivalent of a PlayStation or paying for your kids' dance classes. I'm a dad of 6. I digress on this, but I do want to know specifically, for my constituents back home, the thoughts of creating a central bank digital currency that tracks individuals. If the Fed were to offer a direct individual accounts to citizens, wouldn't this be a direct threat to the financial privacy of many Americans?
Potentially, and that's why it's not something we support. We would not support, accounts at the Federal Reserve by individuals. That would not be. If we were to, and we're a long way from this, if we were to, support at some point in the future a CBDC, it would be one that were intermediated through the banking system and not directly at the Fed for exactly the reason you point out.
I'm very happy to hear that. I think that's a good partnership with the individuals there and a respect for Americans across the board. With that, I yield my time and recognize the gentlewoman from Colorado, Ms. Peterson, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us again today.
This is Colorado Democrat
I come from
Brittany Peterson.
Colorado. I was in the legislature for 10 years, and when the pandemic happened, I was part of being one of the, unfortunately, elected people during that time, that difficult time. When I think about what our country was going through a few years ago, where our economy was almost in free fall, completely shut down, our local governments they were slashing their budgets, they were laying people off, and what that moment meant that we had to do in stepping up at the national level to infuse dollars to save our country's economy. So my frustration here is that we continue to talk about inflation as if it was spending just to spend money, instead of acknowledging the urgent crisis that this country and this world was in, and what we needed to do in the moment to make sure that we were able to recover, keep our small businesses afloat, our local governments, and ultimately recover much more quickly than others. So since we talk about this often, I'd like to know, if you look to other countries around the world who didn't infuse dollars like we did, is there countries that we can look at to compare what the outcomes would be, and what is their recovery like now?
Our recovery is by far the strongest of any country. And I would say inflation that we have is actually, everybody has very high inflation. The EU, the United Kingdom, many countries within Europe as well.
Thank you. That was my next question, is how we compare to other highly developed economies on our recovery. So it sounds like in the emergency that we were in, the hopefully once in a century global pandemic, that the United States ultimately met the moment, and that when the American people look at what has been done, we should feel really good about where we are, but we know we have a long ways to go. And so I also want to acknowledge that something that comes up often is that rising debt leads to increase in higher rates of inflation. Doesn't that also include tax cuts, trillions of dollars of tax cuts that we couldn't afford that went on our rising debt?
In terms of today's inflation? So I think if you look, to your point, you look around the world, there's a common factor that has driven inflation very high in lots of advanced economies, and it's the pandemic, and it's everything about the pandemic: the closing of the economy, the reopening of the economy, the fiscal support, the monetary support, all the things that happened went into high inflation. And inflation is coming down. We'll look back on this, and we'll be able to look back at a period of very high inflation. But I think it's not just monetary and fiscal policy; it's also just things to do with the pandemic, various shocks.
Absolutely. It's hard to believe where we were a few years ago and where we are now, although we do have challenges ahead. Another frustration that I have here is our failed policies around immigration reform and providing legal pathways for workers here in this country. When I talk to business leaders across the country, they say that the number one thing that we could do to address inflation is address legal pathways for people who want to work here. And so, while I recognize you say your job is to address inflation, you are still limited only within the tools that you have. So my question to you is, would an increased labor supply help supply chain issues and inflation in this country?
So we're seeing that now very much. A little bit to our surprise, we've seen a bounce back in labor force participation and also a significant return to the prior trend in immigration. And that we believe, and most analysts would say that that's part of why employers are finding the labor market to be a little bit less tight now. It's still extremely tight, but that more labor supply is helping the labor market get back into balance, including through immigration.
Great, thank you. Another concern that I have is not just now our inability to address legal pathways to work in the United States and the consequences of not doing that to our economy. I really worry about in the long term if we don't address our labor shortage. So I'd like to know if we are unable to provide these pathways looking at the needs of this country, do you see this contributing to the rising costs and inflation here in the United States in the long term?
I'm not sure about the long term, but I would say that, right now still employers are reporting a very significant excess of demand for workers over the supply of workers. And so there's a lot of demand out there for people to work.
Thank you, Mr. Chair. The lady's time has expired. I now recognize the gentlewoman from Texas, Ms. Dela Cruz, for 5 minutes.
I thank the chairman for holding this important hearing today. It is critical that this
Texas
committee
Republican Monica
continue
Dela
to
Cruz
explore
begins her
how
questioning.
Biden
Fed Chair Powell will check the markets real quickly for you. The S&P 500 is down 16 points right now. The Dow is up 14. The NASDAQ is lower by 156, a drop of 1.1%. The 10-year Treasury is down 14, 30 seconds. The yield 3.77%. You're listening to live coverage of Fed Chair Powell's semi-annual testimony to the House Financial Services Committee on Bloomberg Radio.
For a largely rural district where my constituents, of which 86% are Hispanic, heavily rely on smaller institutions or community banking institutions for their financial needs. I am concerned about Mr. Barr's focus on factors that aren't necessarily material to the recent bank failures. His report on Silicon Valley Bank seemed to go out of its way to advocate for higher capital levels as a cure for the recent bank failures, instead of the failures of regulators and bank mismanagement. In fact, one of your other colleagues, Federal Reserve colleagues, Governor Bowman, echoed these concerns in recent remarks when she said, "The unique nature and business models of the banks that recently failed, in my view, do not justify imposing new overly complex regulatory and supervisory expectations on a broad range of banks. If we allow this to occur, we will end up with a system of significantly fewer banks serving significantly fewer customers. Those who will likely bear the burden of this new banking system are those at the lower end of the economic spectrum, both individuals and businesses." Just a couple moments ago, Rep. Donalds asked you a couple of questions, and your response was that you mentioned how important community banks are and that you are keeping them in mind with all that you do. As I speak with my local community and regional banks, they say that the increase in regulation and in capital requirements will really hurt them. With that being said, what I find as being an outsider in politics, new to the political arena, I find that people here in Washington, people who hold leadership positions, are often out of touch. And so I want to ask you, Chair Powell, do you personally bank with a community bank?
I have over time, not currently, but yeah, the last mortgage that my family and I had was you would like the story, I can tell you someday, but we had a very large bank which sort of failed at the last minute to come through with our mortgage, and we went to the local community bank, and they knew my family, and they knew the house, and they were able to give us a mortgage without difficulty within a few days. So I have very positive experience with community banks.
So with your relationship with community banks in the past, how do you feel that increasing regulatory burdens would have consequences to these community banks?
So I really think that the things we're looking at are not about community banks. They're about the very largest banks, and to some extent, banks in the Silicon Valley Bank range is sort of 100 billion to 250 billion. So that's far larger than I would consider a community bank to be, under 50 and probably under 10 billion in assets. So those are not the focus of the regulatory reforms, I believe, that are going to be proposed to the board for consideration this summer.
And I will also hope that be true, because, as I said, in my district, we have a lot of community and regional banks that would suffer with increased regulation and capital requirements. And so with that, I have very little time, so I will yield back to the chair. Thank you.
The gentlelady yields back. I now recognize the gentleman from California, Mr. Sherman, for 5 minutes.
I want to comment on one success story. Several years ago, there were $16 trillion of LIBOR instruments where the amount the debtor was supposed to pay the creditor was to be determined by the London Interbank Rate. And as of June of this year, that rate will no longer be published. Something happened unusual here in Washington. A year and a half before the LIBOR hit the fan, Congress acted. You published your regulations in February, and the problem is solved.
This is Democrat Brad Sherman of California.
Pick up on the ranking member's comment that it's critical that we deal with housing. There's a lot we can do in Washington, but we also need to get cities to allow the construction of apartment buildings and condos. Someone has talked about the de-dollarization. We need to compete against the euro and against the yuan, but one place where Congress can act is with regard to crypto. The crypto billionaires have told us they want to displace the dollar. They're working for de-dollarization, and when billionaires tell you they are trying to hurt your country, you should believe them. There's been a discussion here as to whether it's the pandemic or Washington, D.C. policy that's caused the inflation. We have a perfect test case. Our annual inflation rate is now at 4%. The European Union, where Mr. Biden is not president and Mr. Powell is not head of their Federal Reserve, the European Union is in May had 7.1% inflation. The unemployment rate in the United States is 3.7%. The European Union is at 6%. And since the pandemic began, GDP has grown in the United States 5.3%. In the European Union, only 3.1%. I think it's pretty apparent that our policy has turned out to be actually better than Europe's policy. Banks and bank regulators have said, oh, how could we possibly have anticipated the inflation and interest rates of 2023? Today we have 4% inflation. That is almost exactly the average inflation rate over the last 50 years. Much lower than it was in the Reagan administration when we had 13.5% inflation, 16% interest rates. And that's why I blame the management and also the regulators at Silicon Valley Bank for telling us that, oh, this was an unanticipated circumstance. It's certainly one of the things they could have anticipated. I'll point out that both the Congressional Budget Office and the University of Pennsylvania Wharton School of Business's models both show that the estimated effect of the Inflation Reduction Act on inflation will be statistically indistinguishable from zero. So we'll accomplish a lot for the environment and not increase inflation. Of course, the recent action by Republicans to take away IRS enforcement will lead to higher deficits and higher inflation. The chair of the committee tells us we don't need regulation of our well-capitalized banks. Why are they well-capitalized? Because of our regulation. And I do want to focus on whether our banks really are well-capitalized. Mr. Powell, are our banks well-capitalized if you value their assets at today's fair market value, where we have experienced higher interest rates and the value of the debt declines? And are they well capitalized even if you assume that depositors are not just going to leave their money lying in the banks, but that the obligation the bank has to its depositors is valued at full face value, but the marketable securities and loan portfolio is priced at today's interest rates? Under those circumstances, do we have a well-capitalized banking system?
So I think you have to take the capital requirements as they are for purposes of this.
Well,
question.
that's the problem. Our capital requirements are hide the facts that are unpleasant.
Right.
If you don't hide the facts, are we well capitalized?
Traditionally, though, as you know, a rising rate environment has increased the value of the deposit franchise, which more than or at least offsets any portfolio losses.
So we're well capitalized if depositors continue to be lazy and stupid.
The gentleman's time has expired. Chairman Powell can submit any additional response for the record. With that, we'd recognize the gentleman from Tennessee, Mr. Ogles.
Thank you, Mr. Chairman.
This is Tennessee Republican
Mr. Powell,
Andy Ogles.
When the COVID-19 pandemic started, the Federal Reserve began a round of quantitative easing, referred to as QE4. Like many COVID policies, this program dragged on, not ending until March of 2022. To conduct this program, the Federal Reserve expanded its balance sheet with short-term interest-bearing liabilities on one side and long-term interest-bearing assets on the other. And this was at a time of historically low interest rates. When predictably, expansionary fiscal and monetary policy sent inflation to the highest level in 40 years, the Fed was forced to raise interest rates rapidly. Now, going back to one of my colleagues' questions about the bank losses and the result of that being poor management and failing to hedge against the interest rate environment, is that a fair summation that management and failure to hedge is what caused some of the bank losses?
Certainly, many banks manage the interest rate risk that came along through that technique.
But some did not, is that correct?
Some did not.
In October, the Fed suspended its remittances to the Treasury due to losses. Mercatus Center estimates that the lost revenue for the Treasury will result in $760 billion over the next 10 years. And so it does concern me that Treasury is blaming banks for mismanagement when you yourself had to stop remittances and will suffer losses. Now, when the Fed prepared its and I said Treasury Fed, but semi-annual monetary policy reports through the time of QE4, none of those reports mentioned interest rate risk would impact the government's finances. Should that have been disclosed, or did the Fed not understand its own risk in correlation to the interest rate environment?
Well, so what we do, we remit all of our profits, right? And in the era of QE, those profits were enormous. We remitted something like $1.2 trillion in profits to the Treasury Department because, you know, we're funding purchases of long-term assets with issuance, as you pointed out, of overnight, lower rate instruments. So, in a way, that's what was happening during the QE era. As we now enter an era of raising rates, that'll turn around a little bit. But ultimately, though, we don't manage at all for fiscal reasons. What we're managing to is maximum employment and price stability, and we're using our tools to achieve that. So we don't think of ourselves as trying to attain some kind of fiscal goal one way or the other.
But what about, as far as, well, I guess I'll ask this question. When you look at, the roughly $700 billion in blow to the Treasury, how's that going to impact the president and Congress's kind of economic plans and policies going forward? I mean, is it going to impact negatively?
It doesn't affect spending, right? It doesn't affect, Congress appropriates money, the executive branch spends it. It will mean that more borrowing has to take place, and that could raise rates very marginally at the margin. But that's how it would affect the budget, but it wouldn't be a major effect on the budget.
Well, I didn't ask about the budget moreover than our overall economic goals. And I think what I think a lot of us are getting at is when you look at Main Street America, when you look at mortgage rates and how it's impacting, families' abilities to get a mortgage. And so someone who was eligible for $300,000 to buy a home now is no longer eligible for that home. You have people that are now upside down due to this, expansionary, interest rate environment. And I have concerns about, future raises and the impact that's going to have on small businesses, availability of credit, and again, your average homeowner. And the people that pay that or bear the burden of that are your lower income and your middle class families. Now, when you look at Silicon Valley Bank, which is supervised by the Fed, again, I get back to when you look at the interest rate increases, why there was not more warning or hedging from you as the impact it may have on the fiscal system, the financial system, and the banking system, because as we well acknowledged, both sides of the aisle, that there was some poor management, but the regulators and the communication from the government was lacking. And Mr. Chairman, I am out of time. Mr. Powell, thank you for being here, and I'll yield back.
Thank you, Mr. Eagles. With that, the chair recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and I thank the ranking member.
As Democrat, Stephen Lynch of Massachusetts begins his questioning of Fed Chair Powell. The S&P 500 is now down 21 points. The Dow has moved back in the red. It's down 11 points. The NASDAQ is lower by 179 points. 10-year Treasury is down 15, 30 seconds. The yield, 3.77%. Live coverage of the House Financial Services Committee and Fed Chair Powell's semi-annual monetary policy testimony on Bloomberg Radio.
Power and that sort of thing. But I do admit that right now, unemployment rates are historically low all across the country. I think Massachusetts, the Fed numbers at 2.8% unemployment. Arkansas, even less. Alabama, even less. So I understand the need for your position. But when you look at the Black and Latino unemployment rates in some of these major cities, they're double that. And I can't help but seeing this as an opportunity to perhaps redouble our efforts to pull workers who aren't traditionally have strong connections to the job market and make things happen. At the federal level, we fund about 25,000 job training programs. And according to the GAO, we don't do a very good job. I think the average program produces about 3 workers per year. But I am aware of the work that the Fed the Boston Fed is doing with the Gateway Cities program. Susan Collins is running that in the Boston area. And the Fed actually helps us with data and coordination. And cities like Brockton, Massachusetts, my district, but also Fitchburg and other more rural areas, the Fed comes in and actually provides a great amount of expertise and has done wonderful, wonderful work. And I'm just wondering, are there other tools in our toolbox that the Fed could use to help? You could soften the labor market by adding workers as well. And I'd rather see that on the supply side than simply restrict credit and squeeze companies into a position where they have to lay people off. And I'm just wondering if there are other tools that you think might be available to us to accomplish that.
So I'll say two things. First, what the softening that we've seen so far in the labor market has been around job openings declining. It has not been around unemployment increasing. We've seen some wages moderating back toward more sustainable levels. You'll remember well the labor market before the pandemic, where we had 2% inflation and a really tight labor market with no inflation, and a lot of the gains were going to people at the lower end. That's where we all want to get back to, because what we have now is a very tight labor market, but inflation is so high, it's eating up the wage gains that these people make. So we need to get away from that. In terms of other tools, I visited East Hartford, which was another one of those cities, and I agree with you. We're not spending taxpayer money on this. We don't have the authority to do it. We convene people who have private sector funds, and we focus on a city. And I was really impressed. I don't know if you sound like you visited one or more of these cities. It's amazing what you can do.
Yeah.
But as a convener, really, rather than as an agency that has the authority to spend money on people. But so I mean, we do think about these things. We think that the most important thing we need to do for working people is to get inflation back under control, because it is people at the lower end of the income spectrum who suffer most immediately and worst from high inflation.
Yeah, I just think there are deeper structural problems in the limitations within our workforce. I met yesterday with IBEW Local 103 in Boston, and I talked to new electrician apprentices, mostly women of color, who they're working days, their husbands are working nights, and it reflects in that very, very low unemployment number, which is, you're getting around 2%. It's really people who are in between jobs. Those are the people that are, so there's no real reservoir of unemployed workers there that you can rely on. And I do appreciate the way the Fed came in, and the Boston Fed came in and big-footed the situation in Fitchburg, where they brought a bunch of people together and they accomplished a lot without spending federal taxpayer money. So I'm going to continue to try to find ways that we could use the resources that you have available. Mr. Chairman, I yield back.
Thank you, Mr. Lynch. The chair recognizes the gentleman from Georgia, Mr. Loudermilk.
Well, thank you, Mr. Chair. Mr. Powell, good to see you again. Thank you for being back here. I want to continue a dialogue that you and I had about FedNow. And I also want to continue voicing my concern that this product is a solution to a problem that the private sector is already addressing. The RTP network is already capable of instant settlement with a much greater degree of connectivity than FedNow will have at launch next month or in years to come. And my concern is also that the Fed has an undeniable advantage over the private sector in the payment space, as it can clear transactions through Fed master accounts. Furthermore, the Fed already has options to improve transaction speeds through existing services. For example, the Fed has discussed extending the operation hours for the National Settlement Service since 2015. So first question is, why not respond to industry demand by improving existing services instead of launching a new one that can compete with private industry?
It's Republican Congressman Barry Loudermilk of Georgia.
Remember, we surveyed all of the banks, not just the large banks who stood up RTP, which was a very positive development that we supported. And overwhelmingly, the smaller banks wanted us to set up FedNow. This was a very overwhelming view among smaller banks. They wanted a Fed alternative to RTP. So we set it up. And I would agree with you. That is not a reason not to work on the efficiency of our other payment services, and I hope we're doing that. I know we're doing that.
So we had also discussed in the past about setting up some guardrails to protect customers from accidental or fraudulent transactions. And we know that's a big issue across the entire financial services sector. And in response to that, you know that the banks already have procedures for customers to report unintentional transactions, and FedNow will come up with a suite of features as well to help institutions investigate and remedy any unintentional or fraudulent transactions. However, with real-time settlements, this becomes a whole lot more difficult than just debiting the account that received funds by mistake. Can you elaborate on how you're going to handle this protection?
Yes, and of course, RTP faces the exact same issues. I mean, it's a problem with real-time payments. You just have to have very high, extra high levels of security around the payments, who the payee is, and that sort of thing. And we do think we can master that and build that in, as any faster payment.
Do you have any ideas of the direction that you're looking to go? How are you going to be able to resolve those? Or is this just something you're beginning to look into?
No, I think we've built very strong safeguards in. I can't give you the technology answer.
Okay.
But we'll be happy to supply that.
Yeah, if you could supply that, appreciate it. Just a couple other questions. Will the Federal Reserve itself use FedNow for real-time payments between banks and in the system?
I'm sorry, will it?
Are you going to use the FedNow for real-time payments between banks within the system?
Yes, I mean, that's what it's for. It's supposed. It's an interbank payment system that allows banks to offer real-time payments to their customers.
Okay, so with that, I'm going to diverge just a little bit. I've dealt with in the past at state level with government competing with private industry. We run into this problem where the government has an undeniable advantage. In this case, it had to deal with internet services, where city governments had gotten involved in internet servicing and started competing against private providers. And the issue came that the city governments were undercutting the private providers because of the pole access fee. So we passed legislation in the state of Georgia that required that any municipal government that provides a service that competes with private industry has to assess themselves the same fees. So with that in mind, will transactions between Federal Reserve banks be subject to the same rules and fees as other banks? Are you going to charge yourself the same fees that the private industry and abide by the same rules as the private industry?
I don't know the answer to that. I will say I wouldn't advocate, in the payment space, there are many, many instances of a government-operated payment system operating side by side with a private sector one. It was not something I would advocate broadly for in the economy. You think about ACH, you think about FedWire. You know, there are private sector and public sector payment utilities operating next to each other in the United States and around the world.
Okay. Thank you. My time's expired. I yield back.
Gentleman yields back. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
This is California
Thank you very
Democrat
much, Madam Chair.
Juan
I appreciate
Vargas.
the opportunity. I want to thank the ranking member, too. Thank you. Mr. Chairman, I've always had great confidence in you. I've told you that personally. Now that you're a deadhead, though, I'm not quite sure. Especially after 50 years. But anyway, again, thank you very much for being here. I appreciate the service you've done for our nation. One of my colleagues was talking about the difference in inflation rates in the United States and Europe, on both sides, actually. One of my colleagues on our side talked about that. And I was wondering if you saw the headline today in the New York Times about the UK inflation rate. And you saw that they're running, I think, at 8-something%.
Yes, I did see that.
Yeah. And you were asked a question by a gentleman on the other side of the aisle that when the Biden administration took over, what you could buy for $1 now cost $1.16, and that was hurting consumers. And you said, and I want to quote you, I strongly agree. But the question obviously inferred that inflation was the fault of the Biden administration. I mean, that's the whole point of the question.
That wasn't the question I answered, by the way.
That's right. And I was going to say that, and I'll give you an opportunity to answer that, because you later said that the pandemic was the issue all around the world. So is the Biden administration the cause of all this inflation?
So just to be clear, the question I answered was, is inflation hurting people? It was nothing to do with the cause of the inflation. And
but it's inferred, Mr. Chairman, when you say that this has happened during the time of the Biden administration. I think the question clearly infers that.
I think you understand the question I was really answering. So I guess I would say again, you know, people are going to be unpacking the causes of this inflation. Many academic careers will be built on new ways to look at this. Former Chairman Bernanke delivered a paper with a colleague just a couple of weeks ago at Brookings on this. You know, and I just think you see inflation everywhere in the world. There's a common factor here, which has to do with the pandemic. There's also a room for fiscal policy. There's a room for monetary policy in the explanation. And I just think it's very hard to unpack that. And I wouldn't, it's not up to us to make a judgment about, we don't render judgment on fiscal policy. We don't support it. We don't criticize it. We take it as something that arrives at our front door. No matter who is president, no matter what fiscal policy is, it's not something we play a role in commenting on or criticizing or praising.
I wanted to give you an opportunity. I appreciate the answer. I wanted to give you an opportunity just to make sure if there was any confusion about that, the confusion was cleared up, and I think you've cleared it up. Now, I want to answer a question that you didn't answer, that you passed on. The question was if Congress should be in charge of setting the federal rates fund. I can't think of a worse idea. The only worse idea, I think, might be another idea that was set forward earlier, that maybe we should be involved in supervising the banks, Congress. We can't even figure out appliances here, for God's sakes. We closed down the government over appliances. We can't even figure that out. I don't know how in the world we'd be setting rates and how in the world we'd be supervising banks. Again, I think you guys can do a tighter job of supervising banks. I mean, I do think that and you guys have admitted to that with the Silicon Valley Bank, and I hope you do. And I know you're looking at these regulations. It was brought up that since 2008, 2009, their capital requirements have gone up, and the banks generally have done well in the stress test. What was the law that caused the capital requirements to go up?
It was a combination of Dodd-Frank and also the Basel Committee.
Of course.
Agreements.
And those are the two things that I've heard from colleagues on the other side. They just keep beating up. Now they don't do it as much, but when I first got here, now that's the CFPB. But that was the choir again, once again, just saying it's the terrible banking. But the reality is it probably saved banking in the United States, and I appreciate it. Lastly, I would just comment this, and you don't have to comment. I'm just going to make this comment. Obviously, your focus is narrow and should be. But the notion of climate change is important. I do think that it's affecting the economy. I do think that it's affecting our world. And I do think that we've had our head in the sand for way too long on this issue, and we have to do something about it. Obviously, that's not your mandate, but obviously it's important. I hope we do something about it. We don't have the courage to do that in Congress. That's why I think others are doing it for us. But we have to do something. We see the bigger hurricanes. We see these things happening, and it's because of our participation in making it happen. Thank you very much.
Gentleman, time's expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Madam Chair.
It's Oklahoma Republican Frank Lucas.
You as well.
Many of my colleagues today, of course, have expressed their concerns about the upcoming Basel III revisions, and I hope you'll continue this dialogue with the committee once the joint rule is proposed and open for public comment. I'd like to follow up with a topic we discussed back in March. I'm sure you're keenly aware of how important it is for banks and companies to manage interest rate risk. Participating during the last several years, the Silicon Valley Bank made that very clear. Could you speak generally to how hedging interest rate risk is an important risk management tool for U.S. banks and companies?
Well, I think you see the reality of it here. When rates go up, banks are encouraged by their supervisors and their own internal personnel and risk committees that they need to manage that risk. And most U.S. banks did a good or adequate job of that, I would say. But it's a fundamental risk of banking, one of the most basic risks, along with credit risk.
Exactly. And on that point, I've heard concerns that the Fed's Basel III revisions could increase costs for derivatives end users, whether hedging interest rate risk or commodity price risk. I'm optimistic that these concerns will be addressed. Having said that, these revisions to capital requirements do not exist in a vacuum. The SEC is proposing major changes of their own. Last week, I asked Secretary Yellen if Treasury is coordinating with the Fed and SEC on economic analysis necessary to understand the potential consequences of U.S. banks implementing both significant market structure changes and increased capital requirements associated with market activities. The Secretary responded that the Fed is, in fact, coordinating with Treasury on this analysis. Are you aware of this coordination, and have you personally been a part of these conversations?
I have not been a part of those conversations, but I do understand that that's correct.
Okay. Chairman Powell, I'd like to follow up with you on your conversation with Congressman Gonzalez from earlier today. You have assured this committee that the Fed is not a climate policymaker, and I appreciate your commitment to this. However, I'm concerned that the Fed's regulatory toolkit would be utilized in a way that would, in effect, require the Federal Reserve to make policy decisions on climate change. We've seen other U.S. financial regulators embark on significant climate rulemaking, such as the SEC. Chairman Powell, are there principles you keep in mind when ensuring that the Fed doesn't give in to, shall we say, political pressure around things like climate change?
There are, and for starter, one would be that we don't see it as at all appropriate for us to tell banks what legal businesses they can lend to. That's not our role. We don't allocate credit. So what we do is we supervise banks to make sure that they understand and can manage the risks that they're running. And we're thinking of that as our point of contact with climate change, in the sense that it's another risk that over time banks need to be able to analyze and assess. So, but fundamentally, though, as I mentioned earlier, climate change is going to be a very important issue for a long time, and it needs to be addressed principally by elected people, because it has enormous distributive consequences, and we don't have a mandate to deal directly with climate change as a policymaker. It does arise in connection with bank supervision, but that's not the heart of bank supervision. That's just a small part.
I very much appreciate those comments, Chairman. On another topic, I'd like to discuss the Fed's balance sheet, which currently stands at around $8.5 trillion. As you know, the size of the balance sheet more than doubled as the Fed worked diligently to stabilize markets during the height of the pandemic. Now, as the Fed begins to reduce the balance sheet, could you explain this process and describe the levels of securities that the Fed would look to maintain in the long term?
So the way the process works is securities mature, and they roll off our balance sheet, and that's the way it works. And there's a cap for MBS, mortgage-backed securities, and also for Treasuries, so it doesn't get too large. And if you hit that cap month upon month, it works out to roughly a little less than $1 trillion a year in shrinkage, which is a whole lot faster than what we did in the last cycle. But then again, the balance sheet is that much bigger. In terms of the level, we're thinking about a level that will allow us to operate our abundant reserves regime with enough of a buffer on top of it, so that reserves won't accidentally become scarce. I can follow up more with you on this.
Thank you. My time has expired, Madam Chair.
Gentleman yields back. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
As Ohio Democrat Joyce Beatty begins her questioning of Fed Chair Powell,
being here today.
we'll check the markets for you with the S&P 500 right now down 13 points. The Dow Jones Industrial Average is higher by 19 points now, and the NASDAQ remains lower by 142 points. That's a drop of 1%. 10-year Treasuries down 12/30 seconds, yield 3.76%. And Bitcoin has crossed 30,000. It's trading around 30,100, higher by almost 7%. Live coverage of the House Financial Services Committee on Bloomberg Radio.
Status of dollar dominance as it stands today, and whether there are risks are to the strength of the U.S. dollar in the international financial system, and if so, what are some of the risks?
So the U.S. dollar is still the dominant reserve currency in the world, and that is principally thought to be as a result of our liquid capital markets, the rule of law, strong democratic institutions, price stability over the years, critically open. Money can come in and out of the United States without all sorts of legal restrictions and things like. All of those things are necessary to provide the world's reserve currency. We have them. There's not another economy that does have all of those features. So as long as we are a country of rule of law and relative price stability and strong democratic institutions and open capital accounts, we can continue to be the world's reserve currency. History shows that this is not a permanent status, but it is a lasting one. And I think in the case of the United States, you know, as long as we maintain those characteristics of our government and our country, then we can continue to be the world's reserve currency.
Okay, thank you. Let me go to another question that will not be foreign to you. You know, as the former chair of diversity and inclusion, I asked you and others of your colleagues, and let me just say for the record, Madam Chair, that Chair Powell was always on point, went out of his way, in my opinion, to make sure that there was fairness and equity for all people. In light of that, I'd like to follow up with Congresswoman Waters' comments, and maybe Congresswoman Velasquez, maybe what she was talking about. Several of our colleagues here in the Senate, the person who preceded you, it had been stated by many of us that we thought through banking deregulations, he was enabling risky banking practices and failing to combat lending discrimination, which for some thought it might have perpetuated racial inequities. A few weeks ago, Chairman Powell, on June the 7th, to quote, you said that we understand at the Feds that our actions affect communities, families, and businesses across the country. And everything we do at the Fed is in the service to our public mission. So could you maybe elaborate, or the time ran out with Congresswoman Waters on, is there anything you'd like to share with us that you do at the Feds that would dispel that there are things that you're not looking at that causes one or members of Congress to think that it is perpetuating racial inequities?
Well, as you know, we do consider, we call out disparate economic characteristics of different demographic groups, including by race, and we want those facts to remain present in the room as we're making our decisions. We try to think of maximum employment we do think of it as a broad and inclusive goal, meaning we're not just looking at the aggregate level. I think it's important to keep those facts in your head as you think about monetary policy. I will say, though, that we have one federal funds rate, and we don't really have tools that address distribution and historical inequities and things like that. The Fed is not an agency that has those things. The best thing we can do for everybody, including in particular low and moderate income communities, is to maintain price stability in over a long period of time, and on top of that, a very, very strong labor market. Those strong labor market conditions are the single biggest contribution we can make on this area.
Thank you, and let me end by saying I appreciate your comments that you said you realize that high inflation imposes hardships as it erodes purchasing powers for food and housing from the least of us. Thank you so much for being sensitive to everyone.
Gentlelady's time's expired. Chair now recognizes the gentleman from Michigan, Mr. Huizenga, for 5 minutes.
Thank you, Madam
Michigan
Chair.
Republican,
Chair
Bill
Powell,
Huizenga.
good to see you again. I wanted to follow up on an exchange that we had back in March, this past March, where we were discussing the parameters highlighted in the Federal Reserve Board's legal opinions that outlined how asset managers can operate without being deemed, quote, in control of a regular bank or a bank holding company. Letters from the Fed's legal division also include certain commitments made by these asset managers to ensure the same result. However, it's no secret that this percentage of ownership held by asset managers will constantly fluctuate as shares are purchased and sold on a daily basis. With the ever-changing ownership structure, someone must ensure asset managers are complying with not only these opinion letters, your opinion letters, prepared by your own staff, but also with the statutory and regulatory framework that the letters outline. So, Chair Powell, I'd like to ask you again, is the Fed taking any steps to assess or monitor whether Vanguard, BlackRock, and others are complying with these commitments made in November of 2019 and December of 2020, respectively? Is that ongoing?
Can you give me 1 second?
Okay?
Good, Chairman Powell,
Sorry, that's
taking
a
a
very
break in the
specific
questioning
question. I didn't know the answer, but so I would say this: we're broadly monitoring the situation. I don't know that we have a particular focus on the asset managers.
Okay, well, those were opinion letters put out by your folks outlining very specific things that could or could not happen. And back in March, when I brought this up, and now again today, I'm looking to find out who's actually minding the store on that. And that, so it's a little concerning that we don't have an answer on that. I guess we'll continue this conversation, and maybe you can answer this. What division at the Fed is responsible for reviewing and monitoring an asset manager's compliance with these opinion letters issued by the board's legal division?
So it would be the general counsel's office. We don't have any reason to think that they're not in compliance, by the way.
But nobody's checking.
Well, we'll check, but
Okay.
I think we know what we're going to find.
I'd like to know what you're going to find, not what you think you're going to find on that. So thank you. I'll be following up with a letter to include some more detailed questions on the topic, and I assume you will commit to getting us a timely answer into that.
I think we offered your staff a briefing on this, by the way.
Yes, and there was a briefing, and let me be clear. Appreciate the cooperation that has happened. We've also had some other briefings. There's been a number of briefings that we've requested, and frankly, your division of government has been more helpful than others, shall we say. So I'm going to quickly pivot to a committee's investigation of the SVB, the Silicon Valley Bank failure. Your staff has been working to get us some answers on our outstanding questions. You did your own report. Now it's our turn. And can you appreciate that our committee is conducting its own independent review of what happened in March?
Yeah, very much so.
Okay, thank you. Will you commit to producing the interview notes and allow us access to the staff who participated in the interviews conducted for the Fed's own internal review of the bank supervision report?
I'm not in the middle of that discussion. I don't know where that stands, so I don't want to make commitments that I can't back up. So I'll be happy to understand where that discussion is and try to work with you.
We're going to be following up for sure on that. When Vice Chair Barr concluded that a, quote, culture shift, his words, happened, do you know if the Fed officials spoke with examiners of other banks, or was this conclusion made solely after the review of SVB? In other words, did they find some systemic problem throughout the Fed?
The thing is, I didn't play any role by design in the preparation of the report, and I'm reluctant. I think I know the answer, but I don't want to guess. So we can give you a 100% clear answer on that, but I'd rather not speculate.
All right. Well, along with the FDIC and Department of Treasury, you invoked the systemic risk exemption, the SRE, for both Silicon Valley and Signature Bank, guaranteeing all depositors would be made whole. For example, regulators could have used orderly liquidation authority, the very tool Dodd-Frank was intended to resolve the, quote, too big to fail institutions while protecting taxpayers. Why was the decision to use SRE made, and do you think that is that we've now lowered the bar to use SRE in future bank failures?
I hope we don't have to face that question again.
We all do.
As long as I live.
But has a new bar been set?
I would say this, though this happened with no warning on in the middle of the night, Thursday night, and less than 12 hours later, we're on the phone with the FDIC, and they're deciding to close the institution and to haircut uninsured depositors. So it was an emergency situation over that weekend. We could see that there was an electronic run building up, and we did what we had to do to address that, and I think successfully.
Gentlemen, time has expired. Chair now recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Madam Chair, and Mr. Powell for appearing. Now, wars have historically been associated with elevated levels of inflation worldwide, although the relationship is complicated and wars can have impacts on both supply and demand.
This is Illinois
Higher
Democrat
inflation
Bill
may
Foster.
just be one of the many prices that the humanity pays for the decision to go to war. Now, we don't have boots on the ground, but there's no doubt that in terms of supply disruption and military spending, both Europe and the US are effectively at war in support of the freedom of the people of Ukraine. So my question is the 2% inflation target a realistic and appropriate goal during a time when much of the world is effectively at war? Or should the 2% goal be thought of as a goal for normal times, with policies being put in place that will return to 2% when the war is over, or at least when we've decoupled adequately from the Russian economy?
2% is our goal, and it will remain our goal. It's a medium-term goal, so we're using our tools to get the inflation level back down to 2%. We're not considering changing it because of the war in Ukraine, and I don't know that that's playing a particularly important role in inflation today, although when energy prices and commodity prices went up at the beginning of the war, it certainly was.
Yeah, well, and certainly it's an important factor for Europe still.
Yes.
The disruption particularly. Well, just more generally, you have been trying to deal with this question of how you balance your dual mandate. And so whenever you're trying to optimize simultaneously two different things, the first step is to put them into common units. So just to be specific here, let's say that you're missing your unemployment goal by 1% and you're missing your inflation goal by 1% in the opposite direction. You know, at some point, do those two cancel? Is 1% in one goal equivalent to 1% in the other, or do you need a 2% missing of the unemployment target? How does what are I guess this must be implicitly, there must be that coefficient there in the Taylor rule and things like this that try to predict your behavior. But internally, how do you view the difference between a 1% unemployment missing of the target versus a 1% of inflation?
The Taylor rule is a pretty good place to start there. Same coefficient on both variables.
Is that really true? I don't know. I'd have to go look at it.
In the original Taylor rule.
Okay,
but
because it's a coincidence if the coefficient is 1, because you could choose a quarterly inflation target or an annual or a decadal inflation target numerically and get very different numbers. So
it's also there's a significant amount of research about the relative social costs of inflation and unemployment, and you wouldn't want to ignore that research either. So I think. There'll be a lot of judgment in this. At the current moment, it's not a question because we're obviously the labor market is extraordinarily strong, and we're very far from our inflation target. So
you're getting complaints from business that the labor market may be too tight. At least it's viewed from the Taylor rule point of view that there is a penalty that you pay when the unemployment gets too small. There is a target you're trying to hit.
But both sides are calling for tight policy, though.
Yes, that is correct at present, but you can certainly foresee times when they will be in tension, and they historically have been. And so you're saying that pretty much it's a 1% on both. That
I think that's a starting place. I think it doesn't lend itself to that level of precision.
Yeah, well, it's either that or you have to face questions like you've been facing for the last decade, and just how do you balance this? Let's see, in terms of the internet or electronic runs on banks, it seems like that's a new thing that's going to have to inform bank capital and liquidity providers. The first question is, if you get a significant electronic run on a significant sized bank, is there anyone but the Federal Reserve that can provide that emergency assistance? Or do you pretty much have to be the only line of defense against big internet runs?
Well, I think regulation and supervision can play a role in that as well. And
that's in stopping the run from starting, right? But
yes.
But part of that stopping the run from starting is knowing that if it starts, that there is someone or some entity that can stop it.
We're the lender of last resort, and that is something that only the central bank can be or do. But I would say changes to regulation to assure that that you don't have this mismatch between runnable liabilities and available cash to fund their run-in. That's something we can address and will address through regulation and supervision.
Thank you. Yield back.
Gentleman's time has expired, and the chair now recognizes herself for 5 minutes for questioning. Welcome, Chairman Powell. I want to start asking about the FOMC, the Federal Open Market Committee's latest forecast It predicted that core inflation will fall below 3% within a year.
This is Missouri
This
Republican
forecast
Ann
has
Wagner.
been the exact same for each Fed meeting over the past 2 years and has been wrong each and every time. Why do FOMC participants continue to make the same forecast, sir? And what data are they reviewing to make this forecast?
So in the world of economic forecasting, we don't really have any advantage over private sector forecasters who've been at this. There's a number of private sector forecasters that are well-resourced, and the data are all public. We don't have private data. That's not how this works. And I think essentially all forecasters have made the same mistake, which is at the beginning thinking that the supply chain problems would be resolved quickly and workers would come back to work quickly and things like that. It's just been, inflation has consistently surprised us and essentially all other forecasters by being more persistent than expected. And I think we've come to expect that and expect it to be more persistent. And
It just seems that we've moved way past the whole transitory thing, and for 2 full years now, they've been saying it's going to be under 3%, and clearly they've missed that. So it was just a little concerning to me if there was something that we're missing. Let me move on. In your press conference last week, sir, you stated that, and I quote, "The conditions we need to see in place to get inflation down are coming into place." What conditions are you seeing that show that we're moving in the right direction? Because I can tell you, my constituents are still feeling great pain of this inflation that continues to persist.
so there's underlying conditions that I'll mention, but the point is you get them in place and then the process of inflation moving down will take a significant amount of time. And we've been consistent in saying that. And the conditions I mentioned would be, first, we need economic growth to be slower to be modest, and it has been at modest levels, so that's happening. Secondly, we need the supply chain bottlenecks to go away and get better and improve. And thirdly, we need the sort of mismatch between demand and supply in the labor market to diminish. And that has been happening. So all of those things are happening much later and much more slowly than we would hope. And my committee and I do believe that the process of bringing inflation down is going to be a relatively lengthy one, longer than we expect.
Well, it's clear that the spending on consumer services, for example, a car oil change, a haircut, or a concert ticket, remain almost unresponsive to rate hikes. Do you have a projection for when we might see this spending go down?
So non-housing services, the broad service sector is famously less responsive to and less focused on rate hikes and the cost of capital. So what we think, and that's about half of core inflation, a little bit more than. So we think, and I think broadly, this is what forecasters think, is that it will take some softening in labor market conditions because in that service sector, it's very labor intensive. By far the largest cost for most service companies is labor. So what you want to see is rebalancing so that demand for labor and supply, a lot of that can happen through fewer job openings and things like that. And we do see it happening.
The Consumer Price Index, or CPI, which measures the price of everything from groceries to cars to rent, has in fact declined from its peak. But this personal consumption expenditures, this is the PCE index, which measures as we were talking about, consumer spending, remains historically high. How else can you account for this difference when it comes to a rate hike pause?
Well, we never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
I think you're right. More rate hikes likely are needed to bring inflation back down to the 2%. And, we're concerned about a hard landing, about recession. So anyway, my time has expired, and I now recognize a gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair.
Illinois Democrat Sean Caston now begins his questioning of Fed Chair Powell. As we watch the S&P 500 fall by 13 points now, the Dow is up 23. The NASDAQ is lower by 141 points. The 10-year Treasury is down 11/30 seconds, yield 3.76%. And Bitcoin is up 8.5%, 30,500. Live coverage of the House Financial Services Committee on Bloomberg Radio.
Climate supervisory principles for large banks that said, quote, the financial impacts that result from the economic impacts of climate change and the transition to a lower carbon economy pose an emerging risk to the safety and soundness of financial institutions and the financial stability of the United States. You've made many comments today that I think are broadly consistent with that in your role, and I appreciate the comments you've made in that capacity. Can I safely conclude that in June of 2023, 6 months after that release, that the Fed's position is still that climate change presents a risk to the global economy and the financial system?
Yes, I mean, I hasten to add, though, that our role in this is an important but quite small one around bank regulation.
Understood, and I'm not asking for the role. I just want to clarify that. The reason I asked that question is because on May 11th, your colleague Christopher Waller at a speech in Spain said, quote, climate change does not pose a serious risk to the safety and soundness of large banks or the financial stability of the United States, and went on to say that the risks posed by climate change are not sufficiently unique or material to merit special treatment relative to others. Should we understand as we sit here that Mr. Waller was speaking in his personal capacity and not as a designee of the Fed, if indeed Fed policy hasn't changed since December of 22?
So I don't comment on on the things that my colleagues say.
So I understand, but you understand the concern that if markets and regulators are to understand that the Fed has a consistent policy, and one of the members of the Fed is saying something that appears to be directly opposed to Fed policy from 6 months earlier, that's a concern.
Yeah, again, it's governors have always had the ability, and Reserve Bank presidents as well, the ability to have their own views on things, and that's going to happen, and that's probably a good thing that we have a diversity of perspectives. I think there may be less in that difference than you suggest. I mean, what I'm saying is that banks, to the extent we have a role, it is to assure that banks understand and can manage the risks that they do face from climate change.
Okay. Well, I don't want to create internal tension, but I think we're all aware that you, above anyone, is aware that your words are closely scrutinized, and we were concerned with the words of your colleagues there. Madam Chair, I'd like to introduce for the record a working paper from the European Central Bank, the impact of global warming on inflation. I don't know if you saw this report that just came out recently, but it says, among other things, that climate change poses risk to price stability by having an upward effect on inflation, both food prices and headline inflation. And what I wonder, without opining on their math, if in fact we are looking at a world where climate change, per the European Central Bank, is going to increase inflation, and we were to find ourselves in that world going forward, would the Fed or other central regulators say we have tools to address this, or are we going to say, well, that's non-core inflation, what are we going to do in hindsight? Because it feels to me like we've got a major bank regulator saying climate change is running the risk of inflation, but I don't even know what tool you would use to address that.
You know, I can just say for now, this doesn't enter my thinking in any way that we would, in the near term, change our inflation goal because of climate change or the need to deal with it. There's a lot of thinking and research that over a long period of time, really the process of investing very large amounts of money in a green transition could drive inflation up, but that's not something we're thinking about today. We are not, during our FOMC meetings, we are not thinking about climate change as something that's relevant to the current inflation or to current monetary policy, and that is very much our focus today, is inflation today.
Yeah, and I guess what I'm struggling with is that if we agree that this is a systemic risk, if we agree that this leads to inflation, and we don't really know what role you'd have with tools, there's a concern there. Last thing I just want to end with, in April of 23, the report on SVB One of the lessons that was noted in the Fed review said that this is an opportunity for regulators and bank managers to be more willing to adopt a precautionary perspective, and that the Fed must strengthen its supervision based on what we've learned. I'm trying to figure out with climate change, if we agree that this is a forward risk, how do we get the Fed the tools to apply a precautionary perspective?
The gentleman's time has expired. The chairman can submit an answer in writing to the record. And I now recognize myself for 5 minutes. Chairman Powell, in March, you confirmed to me that the Federal Reserve is a consensus organization built on garnering broad support before agreeing to any proposal. And given the breadth and scope of the potential changes to the capital framework that is under review right now, that consensus-driven approach seems to be all the more important. I am concerned that the Vice Chairman for Supervision is seemingly been given far too much latitude to act unilaterally, and especially in light of Section 1107A1 of the Dodd-Frank Act, which provides the Vice Chairman for Supervision authority only to develop recommendations for the board and oversee supervision and regulation. Can you speak to the process that's underway? Is the Vice Chairman acting unilaterally, or is that a wrong characterization? And if so, if it's just a recommendation, can you walk through the steps that the board will take from recommendation to a vote?
It's Republican Congressman Andy Barr of Kentucky.
What you see is very much the way the statute works, which is the Vice Chair for Supervision has the responsibility, the obligation to develop regulatory proposals for the board that will be considered by the full board. He's, as I mentioned before in another context, he's not the comptroller of the currency. He brings proposals to the board, and the board votes by majority vote to support them. Or not, and that's how that works. In terms of supervision,
is he including other members of the board currently as he's?
So I think all of us have been getting briefings on what's developed, but ultimately the job is to present something to the board for consideration by the board.
And how long will that, once he presents his recommendations, how long will there be debate, deliberation, and is that transparent for the public?
There will be a meeting, it could be a virtual meeting, this summer to vote on these things. In the meantime, there's a lot of conversation going back and forth now, and we're sort of in that process now, but things are still moving around.
Our concern, Mr. Chairman, is that it seems right now the Vice Chairman is writing personalized assessments of bank failures and results of new Fed climate scenario experiments without a whole lot of collaboration with other governors. And so, given that this new scheme could raise capital requirements by as much as 20% in an already well-capitalized banking system, and that the cost of such changes could be $100 billion or more in lost GDP, I am concerned with your testimony that this would only be a virtual vote. Shouldn't this be a more transparent public board meeting and a deliberative process that includes all members of the board?
It's really just a question of calendars and when will people be. It's the summer, but that's something we haven't decided what form the meeting would take. Would it be virtual?
Well, given that it's a pretty big decision, and that the law requires the full board to make this decision and not one board member to act unilaterally, we would hope that the Fed would hold public meetings on the new proposal. Will you and the Federal Reserve Board commit also, when the proposal is voted on, to also include your economic analysis that would justify whatever capital changes are made in a quantitative form?
I don't know that. I'm not sure we will have exactly what you're looking for, but we'll create a public record that supports the proposal, whatever it turns out to be, and the votes will be what they are, and it'll be subject to public comment and analysis, no doubt.
Well, in order for the notice and comment period to be meaningful, I think market participants will need to understand on a quantitative basis what the justification is for additional capital requirements, if in fact that's what the proposal is, given the fact that we already have a very well-capitalized system. I don't have much time left, but will you also commit to proposing appropriately tailored regulatory requirements based on the complexity and size of the financial institution?
So I will commit to supporting that. I can't commit to what the final product will be or what the vote will be, but as I mentioned at the outset, I do think we benefit hugely from a very diverse banking system, and I wouldn't want to do anything to jeopardize that.
Finally, earlier this week, the Wall Street Journal published an article that stated that, unlike your predecessors, you have not focused on fiscal responsibility. Would you like to correct the record regarding that?
I would, thank you very much. So it was just an op-ed, but it was factually incorrect. I mean, there are countless times, and you've heard me do this, I've said the same thing that my predecessors have said, which is that the United States federal budget is on an unsustainable path, which means that the debt is growing faster than the economy, and that we're going to need to fix this, and sooner is better than later.
Time has expired. Thank you. And the gentleman from New Jersey, Mr. Gottheimer, is now recognized.
Thank you.
This is New Jersey
Chairman,
Democrat
thank you
Josh
for
Gottheimer.
being here today, Chairman Powell. I'm particularly concerned that the current regulatory environment disadvantages small and regional banks. Specifically with First Republic's receivership, I'm concerned that the largest banks were given preference in the bidding process, just enabling the larger banks to grow even bigger. My understanding is that certain regional banks were unable to bid on First Republic because of an extensive and time-consuming vetting process put in place by regulators that put them at a disadvantage in the bidding process. Mr. Chairman, are you aware of a regulator-mandated pre-approval process that banks must complete to bid on firms going into receivership? And is there a notification process for informing banks that they can go through this process? Because I'm concerned that some who wanted to bid on First Republic were unable to.
So this is entirely something within the jurisdiction of the FDIC. We play an important role here, but when it comes down to selling a closed institution, that's just something the FDIC does according to our own procedures. To my knowledge, there were a bunch of regional banks involved in bidding for First Republic.
Do you know if, to your knowledge, if any were said they could not participate, or your understanding was that anybody
Honestly,
could participate?
I'm not aware of any, but I wouldn't be. That really is a question for, that's the heart of what they do. They have the lore, they have the people who have the experience and everything.
Thank you. Small and medium banks hold a large portion, as you know, of our country's commercial real estate loans. The Federal Reserve's May financial stability report stated that the higher interest rates may be increasing the risk that commercial borrowers are not able to refinance their loans, and that a correction in property values could lead to losses by banks that hold commercial real estate debt. I'm particularly concerned that such a correction threatens the stability of lenders and thousands of jobs in my district in northern New Jersey. How's the Fed looking at this and helping small, medium, and regional banks manage their portfolios or think about the risks of commercial real estate loans, and what guidance is being provided to banks given that nearly $1.4 trillion in commercial mortgages are set to mature in the next 2 years?
So following it very, very closely, and I think you put your finger on it, this is a problem more for smaller banks, and not for all smaller banks, but it's the banks that have high concentrations. There will be losses, particularly in the office and in some of the mall sectors. And what we can do, there's a supervisory playbook, and so the supervisors are in there, they're working with the company to help it preserve capital and do the right things to get through what may be a difficult time for some banks that have a high concentration.
Thank you so much. As was discussed today, there's concerns, obviously, that banks may be tightening their lending process and processes and tightening what's available. Are you concerned that higher rates and the recent instability in the banking system will lead to a credit crunch that can make it harder for small businesses to finance their operations and potentially lead to rolling blackout of loan defaults across industries?
So we're watching that very carefully. Bank credit conditions have been tightening for a year, and that's partly as a result of our rate increases. We're very alert to the possibility that the sort of shocks that happened in March might exacerbate that. We don't see a lot of evidence yet on that, but we wouldn't have expected to. So it's something we're going to continue to monitor carefully.
Are you concerned at all about the non-banks and what the crunch that could happen on that side?
Yes, I mean, the banks are obviously highly regulated and have capital and that kind of thing, and some of the non-bank lenders are in a very different place, and so, but we don't regulate and supervise them, and so it's something we're watching.
How do you think we as Congress should be looking at the non-banks? Is there any recommendations?
Where there is same activity, there really ought to be same regulation. You shouldn't be able to conduct the same activity. We regulate these things for a reason, and if we're not regulating them appropriately, then that should be changed. But if you can just go across the street and start a business that does the same thing without the regulation, then that's not going to be effective or fair.
With Basel III conversations up and running and obviously driving towards some conclusions, it appears, or recommendations, is that something that you've been watching? Obviously, you have Fed representation there. What are your largest concerns in terms of requirements and how you're thinking through that right now?
So I think these are going to be very important. A number of very important proposals are coming, and I would just put out a couple principles, and that is, our banks are strong and they're well capitalized. I think that's pretty broadly agreed, and I think we're going to want to understand how even higher capital is justified. There'll need to be a case made for that. Almost as important as that, or maybe more important, is that we need to respect the diversity of institutions that we have in this country. And we benefit from having banks of all different shapes and sizes, and we don't want to push regulation or capital, for that matter, to a place where only the biggest banks have a viable banking model. We're a long way from that. I just think we need to keep that in mind.
Or be disadvantaged compared to our foreign banks. Okay, thank you so much. I yield back.
Thank you.
Thanks. Mr. Chairman. All right, that was Fed Chairman Jay Powell testifying in front of the House Subcommittee on Financial Services, and his message is consistent and it's clear. He says the higher interest rates are needed to curb inflation. He even said 2 more rate hikes in 2023 are, quote, pretty good guesses. He says central bank is overachieving on its employment goal, according to Mr. Powell. So testimony, which is very consistent with what we've heard from the Fed and many of its officials. Right now, I want to get a quick check of the markets here. The S&P 500 kind of off about 0.4%. The NASDAQ off about 1.1%. Yields are slightly higher. 10-year Treasury, 3.76% on your 10-year. I want to call out Bitcoin. Bitcoin is up 7% right now. It's above 30,000. It's at $30,173 per token. So it's had a heck of a run here off the bottom. It's the highest since, it's above $30,000 for the first time since April, buoyed by crypto initiatives involving major players from the traditional financial sector. Crypto investors have drawn support from the start of a digital asset exchange, EDX Markets, it's called, backed by firms including Citadel Securities, Fidelity Digital Assets, and Charles Schwab. So some big names there. Separately, BlackRock and WisdomTree have applied in quick succession to launch a spot U.S. Bitcoin exchange-traded funds, so ETFs for Bitcoin. So getting a lot of support in the marketplace, renewed support, I think, for all things crypto, and particularly on the Bitcoin front. So we'll keep an eye on Bitcoin again, trading at $30,100 per token. Coming up, Sound On with Joe Matthew from Washington, D.C. He has all things D.C. related. That starts right now.
In the space. But, when I think about participating in activities, one of the core functions that has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So,
isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money, and as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically, and I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause? Everything's been settled?
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves. So you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time. And I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and, frankly, when you look at the requirements for capital and the alternative returns in the market, there's a concern. Well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. Yeah, so I would love to follow up with you on it. Maybe align my own views with the thinking at the Fed and with some market participants. When I think about the Federal Reserve, of course, we think about monetary policy, and we want Fed autonomy on monetary policy to some extent. A lot of non-market intervention that, to me, continues to be a cause for concern. Continued purchases of mortgage-backed securities, for example, prevent real price discovery. Is Fed's purchasing propping up prices, or is it holding them artificially low? It's a non-market influence, and I think it has some distortions. So as chairman of Housing and Insurance, I continue to be concerned about that. But the other thing is, really, the big concern is the regulatory side.
Gentleman's time's expired. We'll now recognize Ms. Garcia for the ultimate question of the day.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. It always is a breath of fresh air to have you here to give us the latest report on from the feds. I first want to thank you personally for working on a topic that has always been dear to my heart and dear to the heart of the Congressional Hispanic Caucus. I know several members have already touched a little bit on issues related to diversity and inclusion, and you yourself said something, and I really was struck by the words you used, that when you look at setting the interest rates, you want to reflect that all Americans in the room when you do it. And in my view, the best way to do that is to make sure that the people at the table making those interest rates decisions reflect what America looks like. So I want to thank you again for last month joining you was Adriana Kugler, who was nominated as the first Hispanic to ever serve on the Federal Reserve Board of Governors in its 109-year history. It took a while, but we're there now, and hopefully that will help ensure that when decisions are being made, that all Americans are indeed in the room with you. And so I want to thank you and the president both for making sure that that happens. I know that in my district that is 77% Latino, we're really proud of that fact. But Mr. Chairman, I wanted to see if you could provide me an update on the federal workforce, particularly within the Fed system, because I think that area too, you may recall we've discussed it before in prior times that you've been here, the workforce doesn't quite look like America. So could you give me an update on where we're at with diversity and inclusion issues related to Latinos in the federal workforce for the Fed?
Sure. Well, I guess the place I would start is a good part of the story, which is the directors of the 12 reserve banks around the country. That's been an area where we've focused heavily on diversity and inclusion, and I think met with a great deal of success. So relatively high numbers. We can give you the numbers. We'll be happy to. Relatively high numbers of both Hispanics and African Americans and other minorities, and majority of women. So that's been an area where we have a free hand to act, and we can do that. I think in terms of the workforce, we actually had a particular focus at the Federal Reserve Board on Hispanics and working hard, particularly devoting ourselves to a tight focus on generating more Hispanic contact and more Hispanic employees. And I think we had some success with that. We spent a whole year of that, doing that a year or so ago. And so, it's a very important, the most successful organizations in American society it's not a coincidence. Not a coincidence that they seem to me to be the ones that have pretty advanced diversity and inclusion programs, so that they do have, you know, all different parts of America represented around the table.
Great. Another area of concern for me has always been affordable housing. I know that is a challenge for us in Houston, and also the challenge of combating the homelessness crisis across America. I know that the ranking member, Chair Waters, this morning filed some bills related to seeking increased dollars for affordable housing and dollars for tackling the homelessness problem. Do these issues impact the inflation rate and the work that you're doing to lower the cost of housing for all Americans?
I think they may have a marginal effect on inflation. I think more, I would point to things like workforce participation. So people need housing so that they can get to the place where the jobs are. And in many metropolitan areas, the rents are very high, so people are having to drive very long routes to get to work. And I mean, labor force participation has an important effect on labor supply, which has an effect indirectly on inflation as well. So.
How long have we had the 2% goal for inflation rate?
Unofficially for a quarter of a century, and officially since 2012. And other central banks.
What factors would have to occur for you to reconsider the 2% since it's been there for so long?
What would have to happen for us to reconsider it? I can't really think of anything. Nothing during my tenure will happen to cause me to want to reconsider it. If you come back in 100 years, it'll probably be different, but it's some unforeseen circumstance, I would say.
Thank you.
Today's time's expired.
Thank you, Mr. Chairman. I appreciate it.
I'd like to thank the Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the witness through the chair, which will be forwarded to the witness for his response. I ask you, Chair Powell, and your team.
All right, so we have been listening to Fed Chair Jay Powell speaking in front of the U.S. House Financial Services Committee. I'm John Ehrlichman.
And I'm Matt Miller. Let's get a quick check first off on the markets as Powell wraps up his testimony here. Concern that rate hikes will need to continue weighing on the S&P 500. You can see the index now down 0.4% after a drop yesterday under the 4,400 level. So now we're trading at 43.70. The U.S. 10-year yield adding 3 basis points to 3.75. The U.S. dollar index comes down just about 0.25% to 12.23. And NYMEX crude adding $1.32 a barrel. So WTI pricing at $72.51. John?
Noted sell-off in the technology stocks, Matt. So as we watch the market react to that commentary from Jay Powell earlier, we know that he outlined his thinking around the rate path ahead. Have a listen.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. We're very far from our inflation target of 2%. We are strongly committed to getting inflation back down to 2% over time. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. Earlier in the process, speed was very important. It's not very important now. Given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
Bloomberg Kaylee Lyons was at the hearing and joins us now from Washington, D.C. So Jay Powell's insistent that the Fed will have to continue raising rates, Kaylee.
Yeah, and he said 2 more rate hikes this year would be a pretty good guess for the rest of the outlook for 2023. And as we were just hearing, he stood firmly by that 2% target and that the Fed is committed to getting back down to that level when he fielded questions about their ability to do so or whether or not that target really was still what they should stand by. It is worth noting, though, that as the chairman talked about the need potentially to continue hiking rates, he did also receive praise from the ranking member of the committee, Congresswoman Maxine Waters, for pausing rate hikes. Interestingly, this wasn't just about monetary policy. He also fielded a lot of questions around the Fed's supervisory role when it comes to banks. Perhaps even more time was spent on that issue. A lot of questions about this year's bank failures and the role of regulation and supervision moving forward. The chairman did say that greater supervision of regional banks is required, but he wants to make sure that smaller banks are not overly burdened, and kept pointing back to the vice chair of supervision, Michael Barr, who will be releasing his full review here coming up. He said that those bank capital proposals haven't been shown to the board yet at this time, but he did say time and again that bank capital is strong. He got a lot of questions from Republicans on the need to make those even tighter, whether or not that really was necessary. There were some other topics that came up as well, the issue of affordable housing, as we were just hearing, climate, also how the Fed can address inequality, but those did not really feature as greatly as some of these other issues. And as always, he did have to get a question or two on fiscal policy, even though he repeatedly says that that's a congressional role. That isn't the role of the Fed from a monetary policy standpoint. He would not comment on the Biden administration's impact on inflation.
All right, Kayleigh, thanks very much. Kayleigh Lines there in Washington, D.C. Let's see how investors are positioning for the Fed's next move. For that, we go to Bloomberg's Katie Greifeld. Katie?
Well, there's still a disconnect between what Powell is saying and what the market is pricing. And if you look at the current setup right now, investors are pricing in about 25 basis points of further rate hikes, still pricing in about 8 basis points of cuts. You can see on both ends, really, that pricing has come in. But again, if the market was taking Powell at his word, that pricing for hikes would be closer to 50 basis points, and that pricing for a cut, that those 8 basis points in red, they probably wouldn't exist. But John, as we know, this is a market that has really come to blows with Powell a couple of times, and it looks like that's still the case.
All right, Katie, and stay with us. Let's also bring in Veronique de Rougy, Senior Research Fellow of Economics at the Mercatus Center at George Mason University for some more perspective. In Kayleigh Lines' recap, Veronique, we heard about Powell's commitment to that hawkish path. What was your reaction to the testimony today?
I thought it sounded very much like what we've heard from Chairman Powell for many, many months. But I'll say that I think it's unfortunate that he won't field questions about fiscal policy. And I know it's become taboo in the last 25 years or so, but previous chairmen of the Fed have actually insisted that they couldn't do it alone, or at least have hinted that the fiscal situation and the commitment of fiscal stability was important in fighting inflation.
Veronique, first of all, it's great to see you. Thanks so much for joining us. I wonder why the market continues to doubt the Fed. You know, after last week, we had numerous guests on Bloomberg television, none of whom seemed to believe that the Fed was going to continue to raise rates. All of them thought the Fed was done. What's the problem with Jerome Powell and this Federal Reserve's credibility?
I think it has to do, again, I don't know, I can't read their minds, but this is a problem that he's had from the beginning, and I think it is because investors have come to believe that ultimately the Fed has their back. And even though it's not, you know, it shouldn't be the role of the Fed to have the markets back. I think they've learned that lesson over the years, that the Fed is going to come to their rescue, that the Fed is going to make sure that they're okay, that the Fed is going to make sure that the market actors are happy, and I think this is why they just don't believe that that he's credible. I will say also that Powell, for all these protests, I mean, it's been really political in a lot of ways. And so maybe they believe that he's going to cave under political pressure.
So, I mean, what would that actually look like? Because you have the fiscal side, as you mentioned, that, you know, maybe they should be getting some help. Then there's the credibility issue, and there's also the political issue. What would caving to political pressure look like at this juncture?
Well, I think he's already done some of that by pausing, I think. And while, I mean, there's a lag, we are nowhere near, you know, being done with fighting inflation, especially with what's happening on the fiscal side. And when you look at, you know, I just think and he said it, to his credit, he says, you know, we're far from being done fighting inflation, but he's paused, which is whatever the reason, right? Since this is what market actors have wanted him to do for a long time, and people in Congress wanted him to do for a long time, whatever his reason, they may believe they've prevailed, and it's the first sign that he's not that he's more flexible than he claims when it comes to fighting inflation.
Veronique, let's come back to something you've mentioned a couple of times now, fiscal policy, and we know he was asked about it today, defaulted a little bit on that, obviously, but what are some of the options that would be on the table if we're sitting here with a Fed that can't tackle this alone and trying to figure out how to tackle these issues, broadly speaking, in conjunction with some potential fiscal policy?
Well, the irony of this hearing, right, is like for someone like me who believes that the Fed can't do it alone and that the fiscal authority are going to have to step in and ease the job of the Fed with fiscal consolidation, is that he was actually testifying before the people who have the power to do this. And I think that the problem is like it's a failure of Congress to actually want to be able to, would be willing to actually tackle our fiscal sustainability problem. Think about it this way. After the Great Recession, President Obama, when he passed the stimulus bill, what did he say? He said, yes, lots of red right now, big deficits, but we will take care of them later. After the Great Recession, we had a big debate over austerity. There were some talks in Washington about fiscal responsibility, for lack of a better word. This time around, not at all, not a word. So, people who are watching shouldn't be called crazy by thinking that there is a possibility that all sense of fiscal responsibility is gone, and this Congress, putting everything on, assuming that it's all and entirely the role of the Fed to fight inflation while they can continue spending like they are, is I think very problematic, and it doesn't bode well for fighting inflation.
Could you actually have faith, Veronique, that this Congress, that either side of the aisle would really have the strength to focus on fiscal responsibility? I mean, even Republicans who are supposed to, I know, but neither side seems to be willing to do it.
Sorry, go ahead, Matt.
No, even the Republicans who should normally be fiscally conservative, right, champion subsidies for farmers. So it doesn't make any sense.
I totally agree with you, and I think I will go even further than you do. When they talk about fiscal responsibility, what do they talk about? They talk about big constraint and big cuts to very small part of the budget. Very small part. We know this is not politically sustainable to want to actually exclude everything and then just put all these big cuts on very small part of the budget. Whether you call it woke and weaponized or whatever, it's still politically not sustainable. On the Democrat side of the aisle, they want to spend a lot, and when they talk about fiscal responsibility, it's always about taxing a very small subset of the American people, the rich. Neither solution are going to work if we're going to be moving forward with putting this country on a better fiscal path. And again, I think we need to understand that the Fed can't do it alone, and that the fiscal authority. This is what's happened in successful in the 80s, right? The Fed didn't do it alone. There was some fiscal consolidation. And so anyway,
Well, taking this out of the hypothetical, you mentioned that this has become taboo, sort of the Fed and fiscal cooperation. Is there any political will for this? And if there is no help from the fiscal side, what does that mean for inflation and for markets?
Well, so I don't have a crystal ball, but is there any hope? I don't think so when you watch the hearing. I mean, he is insistent that while he will admit, like his predecessors, that we're on an unsustainable fiscal path, that there's nothing he can say about the fiscal side, about what Congress should do. Even though I remember that during the pandemic, he was cheering the adoption of fiscal stimulus and the American Rescue Plan. So I guess there's a double standard there. But I think it also needs to be an understanding on the part of Congress and on the part of the broader government, which is that inflation will not be, it can be fought with the Fed alone, that they too have a job. And for the last 25 years, we seem to have totally forgotten that message.
Veronique, it's a pleasure speaking to you. It's been far too long. I hope we can get you back as soon as possible. Veronique de Régie from George Mason University, as well as Bloomberg's Katie Greifeld, talking about the Fed, the fiscal side, and the market reaction. Coming up, home builders have been on a tear, raising the bar for one company reporting after the bell today. That's our stock of the hour. Next, this is Bloomberg.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Markets. I'm John Oakman with Matt Miller. Time now for our stock of the hour. We're keeping an eye on KB Home. Set to report earnings after the bell. Strong housing starts and limited home supply pushing home building stocks way up. And Bloomberg's Simone Foxman joining us to talk a little bit more about this. Part of the irony, I guess, Simone, the fact that you've had just a limited amount of supply in the marketplace, maybe opening the door for some of the home builders these days.
Yeah, that's right. The focus on home builders was so much about these high interest rates that apparently were going to deter buyers. But now we're really seeing these home builders talk about the potential for a new normal. Consumers that have adjusted to higher mortgage rates and therefore in the market, and there's no inventory. We saw a ton of really optimistic data coming out. National Home Builders Sentiment Survey up 6 months in a row. Those housing starts speeding. That's what's driving a lot of these home builder shares higher. KB Home, interestingly, though, really catering to move up buyers, to some of these first-time buyers, and that makes it a little bit different than some of these other names like D.R. Horton or Lennar that have reported in the past. Is that bar too high for KB Home? I think that's what we're going to see after the bell.
So how does KB Home compare to the other home builders? I mean, they were all on a tear yesterday.
Yeah, I mean, not only the sector that it's aiming towards, this lower, more modest income sector that has been the focus of a lot of these retail earnings calls as seeing the pinch, but also because of the places where they are. They're heavily exposed to California, where there have been tech layoffs. Texas home prices have fallen pretty substantially, and that is something that could weigh on the shares if we don't see them meet those estimates.
All right, Simone, thanks very much for joining us. Bloomberg's Simone Foxman talking to us about the home builders, which have been a hugely important part of this market, especially over the last couple of days, and we'll look to KB after the bell for earnings. For John Ehrlichman, I'm Matt Miller. I'll be back in just a moment with ETF IQ on Bloomberg.
From the world of politics,
we're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Limes.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. We just got finished watching Jerome Powell testify. The Fed wants to continue raising rates.
He does. He didn't bring up ETFs.
No, not at all?
Strange.
All right, well, we'll cover that for him right now. We're going to get to the biggest stories in the more than $10 trillion global ETF industry. Powell testifying before the House saying that despite the recent pause, rates will need to move higher further to curb inflation.
And fighting for a spot, BlackRock revives the fight for a spot Bitcoin ETF. And as it and others file for several of these products, there is, of course, resistance from the SEC.
And all this month, we've been celebrating equality. Today, we're going to look at one ETF that's supporting women in the C-suite.
And Matt, Eric Balchunas, sadly, is on vacation this week, so I'll be taking a look at the flows. Let's look at where money has been going in the ETF industry. We'll start with the inflows. You can see IVV up at the top. That is an S&P 500 tracking fund taking in about $2.8 billion. You go down the list, you have some credit in there as well. LQD, that of course is investment grade debt, taking in $1.5 billion. RSP, we've been talking about this equal weight S&P 500 ETF from Invesco, taking in another $1.5 billion or so. And also the financials seeing some love as well. So those are the inflows. Let's take a look at the outflows. You have SPY up at the top. Of course, SPY, it's very liquid. It's a trading tool, so can't read too much into the outflows or the inflows, but you can see it lost about $4.5 billion in the past week. So did too the Qs, $2.6 billion worth of outflows in the past week. Maybe some saying, okay, tech has come pretty far. Maybe we're at the top. And small caps, IWM, also seeing some money come out as well. But I wanted to steal some of Eric's thunder since he decided to take a vacation. He's been talking about the FOMO drought, basically how fixed income ETFs have been taking in more money than equity ETFs, but that dynamic has finally flipped on the year. For the bulk of 2023, now we have equity ETFs finally in the lead, taking in almost $10 billion more than fixed income. If you look back in March, you can see that fixed income really had the upper hand over equity, but finally stocks are back in charge, Matt.
All right, very interesting stuff, and too bad that Eric missed out on it. Joining our conversation now is Anna Paglia, Global Head of ETFs and Index Strategies at Invesco. And what do you think, Anna? You know, it looks like investors are coming back into U.S. equities in the ETF world. Of course, they've been driving up stocks in the market. Are they a little bit too late to the rally in ETFs?
Hi, Matt. Thank you for having me. I don't think that they are too late into the rally in equity and the equity ETFs. There is definitely a story about equity. There is a story about the growth coming back into the picture. And we clearly see that by tracking our flows and tracking our assets. Katie has already mentioned one of the rebound ETFs in terms of flows, and that is RSP. After a little bit of a pause based mainly on uncertainty and high drive of the mega caps in the S&P 500, the story about diversification is coming back, and we can see that with flows into RSP. But we also see very positive flows into growth, innovation, and technology. Don't be confused or misled by outflows into the QQQ, because we assess longer-term investor sentiment into growth and technology by looking at flows into QQQM, and that product is up $4.5 billion year to date. So there's definitely a comeback of equity. It doesn't mean fixed income is going away. I think that flows into fixed income will continue. We will continue to see that, but equity is definitely on a rebound over the last few weeks.
You bring up QQQM, which of course has been a great success story for Invesco. I believe it's over $10 billion in assets. Let's talk about QQQJ, because that's one of these Q-related products. It hasn't taken off to the same extent that we've seen QQQM's. Currently, QQQJ has around $722 million in assets after launching in October 2020. So when I think of QQQM, I think, okay, it's the NASDAQ 100, but cheaper. What's the pitch for QQQJ?
Well, Katie, QQQJ is the NASDAQ, let's say 110 to 200. So for us, that is a mid-cap story. And you are right when you say that there has not been an uptick into flows into that product over the last couple of years. We saw very strong momentum when we launched that product as part of the innovation suite. However, it's not surprising to see a slowdown in flows because 2022 was not the best year for growth, especially mid-cap growth. We do believe that there is tremendous value into this product because it is a mid-cap story into a launch pad into QQQ. Stated otherwise, if you think about companies like Netflix or Tesla, they would have been in a QQQJ before, let's say, graduating into the QQQ. So if you are looking at following a company in their growth trajectory, mid-cap growth is definitely when you want to start before you move into large cap and mega caps with the QQQ.
I wonder if, we, Anna, have been a little bit obsessed with the narrowness of the rally that we saw in stocks for weeks. And now we've seen more breadth over the last month. But I wonder if it makes sense for investors to get into, equally weighted indexes in order to profit off of gains from the rest and not have to worry about those that have already gained.
Well, you are raising a really good point. We believe in the equal weight story when it comes to RSP because we think that concentration matters. And when the growth and the revenues are driven by mega caps, you want to look at equal weight as a way to really remove that concentration risk. So it's very much a defense story more than a revenue or a performance-based story. However, not all equal weight products are created equal. So, for example, we believe in the stronger value of the QQQ because the QQQ is more of a thematic product. So if you believe in the theme of innovation, healthcare, technology, consumer discretionary, you really want to be in those stocks that are driving performance for that index. So we definitely buy in and we support the story of diversification when it comes to RSP. But if you're looking for a more of a thematic exposure and laser-tailored exposure to a sector or an industry, maybe equal weight is not really the way to go.
And we only have about a minute left with you, I'm sad to say, but I did want to ask, because if I look at Invesco's lineup right now, I see about 224 funds, only 18 of which are actively managed. And that's been one of the stories in the ETF industry this year is sort of this arms race for active. When you look at the white space in Invesco's lineup, do you see space for more actively managed strategies, or do you see your bread and butter as really those index tracking funds?
Well, Katie, that's a good question because, let me just state that I think we are doing a disservice to our clients if we continue to talk about products in terms of active or passive. We do have strong capabilities in the passive side of the house. We do have strong capabilities in the active side of the house. So as long as we can find value for what our clients are looking for, we will bring an ETF that address their needs, whether that being active, whether that being passive or what have you, it doesn't really matter. But I do think that we will continue to build active components to our lineup as a complement to the more rule-based passive strategies.
All right, Anna, thanks so much for joining us. Anna Paglia there of Invesco talking to us about their lineup in these markets. Coming up, BlackRock makes a splash with its spot Bitcoin ETF filing. We'll discuss that next. This is ETF IQ on Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Only on Bloomberg TV and radio. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with small caps. We're looking at IWM here. It's a fund that tracks the Russell 2000. You're looking at combined put and call open interest. Hit a record high this month. Of course, we know that small caps have been a really interesting space. We can see now that options traders clearly agree. Let's also talk about single stock ETFs, because we're almost halfway through this year, through 2023. This is the best performing fund on the market right now. It's NVDL. It is 1 times long exposure on NVIDIA, sitting on year-to-date gains of 360%. That's what happens when you combine the best performing stock with, of course, leverage that's been working out. We'll see what that looks potentially on the downside. But let's talk about the ETF story of the past week. Of course, BlackRock filing for a spot Bitcoin ETF on June 15th. This caught a lot of attention since, of course, the SEC has repeatedly rejected the structure. And, of course, we're talking about BlackRock here, the world's largest asset manager, that has spurred a flurry of similar funds. You can see Bitwise, Invesco, and WisdomTree, just some of the issuers who have followed in BlackRock's footsteps here.
Yeah, very interesting stuff, Katie. Let's talk more about this with Athanasios Sarafagis of Bloomberg Intelligence. And I wonder, first of all, Athanasios, why the SEC has rejected all of these previous attempts. You know, what is the problem that they have with an ETF that essentially holds a basket of a commodity? They agree that Bitcoin is a commodity, not a security.
Yeah, I think their whole issue was with surveillance, right? And it looks like this issue, or BlackRock has figured it out. But I think also the previous filings had figured this out too, but it's different when it's BlackRock, right? And the other thing is these products exist in Europe, so they know that structurally it works. It works in other markets and in Canada. So I guess it's just the SEC's hung up on it. But what I found interesting about BlackRock, they didn't file in Europe. All the other firms that have shown interest in crypto, Invesco, WisdomTree, all have done it over there. BlackRock sort of skipped that step and just went straight for the U.S. filing.
Let's talk about the BlackRock piece, because I've talked to a lot of investors and analysts analysts about this in the past week, and every conversation starts with, well, it's BlackRock. Why does that matter? What signal does that send?
Yeah, it's just, like you said, they're the largest asset manager, right? It legitimizes it. Now, not to say that the other firms that did it weren't, legitimate or big, but this is BlackRock. They have access. They are, the kings of ETFs. And this reminds me a lot of what happened with fixed income. They weren't the first to try this, but they sort of perfected it, right? And when they stepped in, it completely changed it. So I think it draws a lot of parallels to what happened, during the early fixed income days.
I was talking to a former SEC lawyer yesterday who said his main concern of the Bitcoin ETF would be settlement. He said he was concerned because of the volatility, but Bitcoin hasn't really been that volatile of late, right? It's been holding in a pretty tight trading range. The days of 20% swings seem to be behind us, and if you have a behemoth like BlackRock in there, they surely could deal with settlement.
Oh, I agree. And if you think volatility is an issue, look at some of the 3X ETFs, or even, I think you showed a single stock ETF that was on there. They're probably more volatile than some of the Bitcoin activity that we've seen. So I think the market can handle the volatility. They've shown a history of being able to handle these types of products.
All right, Athanasios, really appreciate your time. That is Athanasios Sarafagis, Bloomberg Intelligence. Still ahead on this program, we're going to drill down into T-bills with Alex Morris. He is the CIO and portfolio manager of FM Investments. That's next. This is ETF IQ on Bloomberg.
Change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller with Katie Greifeld.
And we're back for today's drill down, where we focus on one ETF. And the ETF that we're focusing on today, it's T-bill. It's the U.S. Treasury 3-month bill ETF. It's from issuer FM Investments. And as you would suspect, it holds T-bills, specifically 3-month T-bills. It charges 15 basis points to do so. And if we take a look at the holdings, so the way this works, again, it's what you would expect. It holds 3-month T-bills. It holds the latest issued security of that tenor. We know that T-bills, of course, have been one of the hottest places to be as the Fed continues to raise interest rates. Cash actually pays something. So it's probably no surprise that if you take a look at the AUM, it has absolutely skyrocketed since this ETF came into existence existence just last August. Only in existence for about 10 months. It's over $1 billion in AUM. And you can see otherwise than that blip that we saw in March, it's been a pretty steady climb. And then it really took off up and to the right. So there's a lot of demand for cash. Matt, you have to think this is probably one of the best timed launches in the past few years.
Absolutely. Katie, thanks so much. Joining us to talk more about this ETF is Alex Morris, CIO and Portfolio Manager at FM Acceleration. Alex, great to have you on the program. Thanks so much for coming in the studio. Let me first ask you about this, I don't want to say craze, but there has been a real drive into fixed income ETFs. Do you think that we're nearing the point where that starts to turn around or at least plateau?
Well, I know equity ETF flows are back, which is good to see. Flows should be up in general. I think that fixed income ETFs are about to hit that next wave of innovation. Things that we did and really focusing on the on-the-runs and lots of other things I know our colleagues are up to that are going to re-energize that flow. Maybe not next month or two, but certainly into next year. If you look at recent filings, a lot of really clever stuff out there, and we're happy to be part of that.
And I feel like the yield on cash, it's sort of entered more broader conversations that you would have even outside of live television on Bloomberg television. You hear people talking about the kind of yields that they can get in cash. And when you look at the investor base, that $1 billion AUM, who is that from? Have you seen interest from retail, or is that primarily professional money manager types?
We see most of it from the advisory space, so professional money managers, some other fellow asset managers like ourselves who find it easier to buy the ETF than to roll treasuries. But also a fair bit of retail investors who've reached out to us and said, you know, thankfully we're here because working with Treasury Direct is difficult or impossible at times. And now there's an opportunity for them to participate, not just in T-bill itself, but in all of its suite mates in the benchmark series where they have a rates tool set, which before they never had access to.
Explain for those who aren't, as immersed in fixed income as Katie is, the host of Real Yield every Friday at 1 p.m. What is an on-the-run security, and what's the difference, or what's the importance of that difference?
Sure. So if you take T-bill as an example, it's a 90-day bill, and the government will issue that about once a week, sometimes twice. So every week, you pick up this new issue. So what you see on Bloomberg is the 90-day yield is the most recent issued one. That also happens to be the most liquid. So if you were to try to buy a 90-day T-bill, it's 45 days old, it's no longer the 90-day T-bill. That was a 90-day T-bill 6, 7, or 8 issues ago. The reason why you want that liquidity is the ability to trade in and out of it quickly and to not pay a large spread. No one particularly has much interest in aging or seasoned bonds. There's a whole business built around trading those. But for most investors, you want the security of knowing what you bought is exactly the yield you're going to get and the ability to know that it's liquid. So if you need to get out of it, you'll get out of it at a fair price.
All right, I want to talk about what's next for FM Investments, because I look at your lineup right now. You have 10 funds with about $1.7 billion in AUM. Of course, T-bill is up at the top, but then you see U2, which is your 2-year tracking ETF fund. I think that you cover the whole yield curve. Do you have any plans to expand into government debt or even outside the world of fixed income?
So we certainly are going to continue doing some interesting things in the Treasury space. We've had a lot of demand for yield and spread plays, so long the 10 and short the 2, and a handful of other items that we'll look to launch. We have some credit strategies we've run for a long time as SMAs that we'll bring out to the ETF marketplace, and then we'll see where we go from there. Certainly equities are on the table for us, but we really want to focus on things that we think will be innovative. ETF marketplace is pretty big. We want to make sure that we're going to make an impact and that we can provide some value to investors.
When do investors start to focus on the longer end?
Now is probably a good time to look at it. We've seen a lot of investors telling us they're not reinvesting dividends in the short end of the curve. They're now taking those and putting them in the long end. If you're a bond trader, you have a love affair with duration. We all do at some level. And I think more folks are going to see the advantage of that. But Chair Powell, even today, is making clear rates will be high for longer. So for the next little while, the short end of the curve is going to be safe. But as you look at long-term total return, you're going to want to start to put some chips further downfield. And we see that with the growth of our 30-year fund, UTHY, that came out and started to pick up assets naturally. And all of that was just internal demand from bond traders looking for duration.
All right, Alex, got to leave it there. Really appreciate you coming to set and getting some time with you. Our thanks to Alex Morris of FM Investments. And before we go, as we celebrate equality this month, here's a special look at another ETF that supports women in the C-suite. Spider MSCI USA Gender Diversity ETF puts principal in investors' portfolios and trades under the ticker SHE. The fund seeks out U.S. large caps that commit to and support gender diversity throughout the organization, driven by research that shows that greater gender inclusion leads to outperformance over the long term. SHE ranks each company on 3 gender diversity ratios that take into account the percentage of female executives and female board members. Top names included in this market cap weighted fund include Amazon, Accenture, Apple, Johnson & Johnson, and Intuit. Since its launch in 2016, the fund has returned around 80%, which widely trails behind the S&P 500. SHE has around $200 million in assets. It started as a bespoke ETF created from one investor, CalSTRS, which invested $250 million at the fund's launch. The pension fund has since exited its holding. SHE has a relatively cheap expense ratio of 20 basis points and gets a green light in the Bloomberg Intelligence traffic light system with 1 warning for its alternative weighting.
And a quick programming note, we will be back at our regular time and place Monday at 1 p.m. Tomorrow, speaking of SHE, right? Tomorrow we have our Focus on Equality, which is every Thursday at 1 p.m. this month with Romaine Bostick and Carolyn Hyde.
Yeah, definitely a lot to talk about. Interesting, of course, to hear that on SHE. This has been sort of an issue with those ESG funds, that you have one anchor investor, and when that anchor investor leaves, you're not left with a lot of assets.
No, but you still see the performance there, and it's kept up with, although still trailing the S&P. If you type in a comp, you can see that. If you missed hearing from Eric Balchunas today, a reminder that you can listen to Eric and Joel Weber on Trillions. That's their bi-weekly podcast that covers the industry. And that does it for me and Katie Greifeld. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
It's not the journey, it's the destination. Jay Powell telling lawmakers rates will go up, but the pace of rate hikes matters a lot less. Live from Studio 2 here at Bloomberg World Headquarters in New York, Romaine Bostick kicking you off to the close here on this Wednesday afternoon. U.S. stocks, they've been on the back foot for a third straight day here. Bullish sentiment getting a bit of a splash of reality with high multiple tech stocks leading declines on the day. Tesla, Microsoft, Netflix among the biggest drags on the S&P as well as on the NASDAQ. And chip stocks like AMD and NVIDIA getting the Heisman. The Philadelphia Semiconductor Index down right now for a fourth straight day. We should point out that the Philadelphia Semiconductor Index has now erased about 2/3 of the gains that it's had here in the month of June. Meanwhile, the Treasury curve shifting higher, almost parallel for the 2-year yield to the 30-year yield. The dollar wiping out earlier gains, and gold right now extending declines below that 100-day moving average. The price action today, it's orbiting around Jay Powell, just wrapping up the first of 2 days of congressional testimony, a reiteration of the Fed's need to continue to move rates higher to contain inflation.
And the process of getting inflation back down to 2% has a long way to go. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year.
And while Jay Powell beats the hawkish drum, Henry McVeigh over at KKR, the chief macro strategist there, says that people are maybe a little bit too gloomy. Investors are poorly positioned for stronger U.S. economic growth. That's what he says in KKR's mid-year outlook. McVeigh actually talking about the idea that, well, you can make a case right now that, well, maybe you should not only be a bit more bullish, but you should prepare yourself and position right now in the market for the potential for a second half that actually shapes up a little bit stronger than what had been priced in. But Abigail, strategist over at Goldman, they beg to disagree just a little bit, basically saying that now may actually be the time to hedge.
Yes, they do disagree, but they're also saying to stay long. So maybe they see a little bit of upside, but it's not upside without risk. And here is the big rally on the year. I mean, this is really incredible, Romaine. The S&P 500 up 14%, the NASDAQ 100 up 36%. Take a look at the stocks up 41%. And then this one is really astounding to me. The S&P 500 semi-cap equipment index up 66%. Its best year since 2003. So these latter two, actually these three, really have all to do with the AI boom. One question is whether or not it's going to stick around. So Goldman is saying, to Romaine's point, you know, this time you might want to be a little bit cautious going into the end of the year. So they're saying that you want to keep your long portfolio, but you want to hedge it for a few reasons. First, something that we're all talking about this year, the crowded bullish positioning in terms of big tech, those big 5, 6, 7 stocks that make up the majority of the S&P 500 and the NASDAQ 100, the narrow rally, high valuations. We were talking about that yesterday, Romaine, with that chip index at a 32 PE, the highest, close to its super high, but also a big divergence from the S&P 500, suggesting maybe it's not going to be sustainable. Big growth already priced in. This recession we're all waiting for, where is it not being priced in? And then attractive alternatives. I don't know as much about that, but the hedging strategy that they are recommending is called an S&P 500 put spread collar. That's basically when you buy, you have your long portfolio, but you also buy a downside put and then you sell an upside call. So basically, whether stocks go sky high or to the downside, you're able to take advantage of it and then keep your long portfolio until we know more on the direction.
Abigail Doolittle there. Anytime you get a market like this, you're always going to get a difference of opinion here about where things stand and where things might go. Liz Young joining us right now. She's the head of investment strategy over at SoFi. Thanks for being here in our New York studios, Liz.
Thank you for having me.
Let's start off actually with that third point that we saw on the screen from those Goldman strategists, and that had to do with valuations. Yeah. And anytime you talk about the idea that maybe this bull market might be a little bit too stretched, this bull market may not be believable, a lot of people will point to valuations.
They will, and if you look at the most common metric right now, which is the PE ratio, right, on the S&P 500, it just recently bumped above the 5-year average. It's been above the 10-year average for a while. It's been above the 15-year average for a while. So you can look at that picture and say, okay, this might have gotten a little bit extended, but you can also take the other side of that and say it's still not at extremes that it's been in the past. And people might also argue that it's not as useful of a metric, especially when high valuation growth stocks are the ones that are leading. So you can look at a couple other things when you're thinking about how extended is the market and what does that look like compared to history. Things like how many stocks in the S&P 500 are trading above their 200-day moving average. That's been moving up. You can see the percentage now more than 60% trading above the 200-day moving average. But the real intricate part of that is that usually if it's a new bull market, you see 80 to 90% trading above their 200-day moving average, and you see that go on for a long period of time. So we're not quite quite there yet. So this is a period, both in economic data and market data, honestly, where depending on what side you fall on, whether bull or bear, you can probably find the data to support it.
At some point, though, you're going to have to see economic fundamentals, and for that matter, corporate fundamentals, in theory, catch up to some of these valuations. We're going to get earnings season start anew in maybe about 2 or 3 weeks' time here. What are you expecting?
Yeah, we're in this kind of quiet period right now, right? There's not a ton of economic data coming out this week. There's not a lot of earnings stuff going on this week or next week. And then it will all sort of heat up into some kind of crescendo of announcements. And then we'll have another Fed meeting. So July may be very exciting for all of us. But earnings, the interesting part about earnings right now especially is that we're about to finish June, right? And a lot of times when we talk about earnings, we talk about forward 12-month expectations. And we're going to get 6 months through the year. We've been talking about the expectations for 2023, which remain kind of flat year over year versus 2022. But now we're going to start talking about 2024. And the 2024 expectations are pretty optimistic. So it's a higher bar for companies to meet. We may start to see some revisions downward if some of those growth expectations don't necessarily seem realistic as we get through the second half of the year. But so far, earnings have held up really, really well. And things have gone probably better than most expect, even though they're beating a lower bar. But they've still held up better than I think many expected.
Absolutely. We've seen that. And I am curious that if you believe in the idea that maybe the Fed is close to ending its rate hike cycle, even if you think they're going to continue raising rates, no one thinks it's going to be more than maybe a couple of more 25 basis point hikes here. Does that end of that rate tightening cycle, does that become a catalyst for this market, an upward catalyst?
Well, if you look at history, and history can only really be a guide, but if you look at history, actually, when the Fed pauses and subsequently cuts, it's typically not good, right? They do it for bad reasons, not necessarily good reasons. I think the hope right now is that if and when the Fed does actually pause for good and start cutting, it'll be just to normalize the environment. We still don't know the answer to that, right? And we're not going to know that. I happen to be in the camp that I really don't think that they're going to have the clearance to hike again. I know that they've talked about doing that, and inflation is still a problem, but we're right in that window where long and variable lags start to really rear their ugly head, that sort of 12 to 18-month window. And we're also right in that window of, after a yield curve inversion, how long does it take for a recession to start to show some of the details that we would see emerge in the data? So I'm not sold yet that things won't cool off and that they'll have to kind of stay on pause just to make sure that they don't go really, really far.
When you talk to clients or even just talking to your peers here, what exactly is kind of the sentiment out there right now? Do people feel bullish, or are they just basically just chasing a rally because they feel like they got to make a few bucks?
I think that people, the ones that have been bullish really do feel bullish, right? And then there have been, and I've been cautious most of this time. There have been other parts of the market that, and people in the market starting to look at it and say, did I miss something? Is something going on here that I don't know about? And what if this is a new bull market? In which case, okay, if I'm going to put new capital to work, where do I put it? And what we've seen over the last couple weeks is other parts of the market start to participate, right? We've seen other sectors kind of come into the forefront. We've seen small caps participate a little bit better. And like I mentioned, more than 60% of stocks in the S&P trading above their 200-day moving average. That was 40% just a few weeks ago. So things have broadened out. My speculation is that some people that maybe were positioned very bearishly have looked at the market and said, okay, I'm not going to buy the really high valuation tech stuff that's run because it feels like that's not a good entry point. But I can buy some of this other stuff that hasn't seen a run yet, which is where some of that participation is coming from. The one thing I would caution people about is that another thing that happens as you get to the midpoint in the year, you've got quarterly rebalancing, semi-annual rebalancing, and if people are up and extended in some of those large cap names, the rebalancing is going to force them out of those large cap names and into something like bonds.
Absolutely. Here, we've been talking a lot about that differential in gains between what we saw in equities and what we've seen in bonds over the last few months. Liz, great to talk to you.
Thank you.
Liz Young, she's the head of investment strategy over at SoFi, helping us kick you off to the closing bell here on this Wednesday afternoon. Coming up, a deeper dive into the testimony we got out of the Fed chair, Jay Powell, beating that hawkish drum, though the question is the data going to support that hawkish undertone? Plus, PIMCO says a divergence between light and heavy crude output making it hard for investors to get a clear picture of the oil market. Greg Shernow over at PIMCO going to be stopping by the big program in just a second, and a sit down with the CEO of HKX, Nicholas Aguzin, stopped by the show a little bit earlier here in the day as that company opens its first office here in North America. All that and more coming up in just a bit. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. We're very far from our inflation target of 2%. We are strongly committed to getting inflation back down to 2% over time. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. Earlier in the process, speed was very important. It's not very important now. Given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
The chair of the Federal Reserve, Jay Powell, testifying before the House Financial Services Committee, day one of 2 days on Capitol Hill. Bloomberg International Economics and Policy Editor Michael McKee joining us right now. Michael, we heard from Jay Powell today. We heard from him a week ago. Was the tone, was the message any different?
Message was no different. As a matter of fact, his statement was almost word for word what he said on Wednesday afternoon. Long day for him, but not much news. The dot plot got changed last week as most members of the Fed raised their forecasts for interest rates for the coming year. So one of the key questions that people were asking today up on Capitol Hill was, well, when are you going to do that? And how far are you going to go? And Powell kind of ducked both of those questions, saying they're going to be watching the data, but that 2 increases this year are a, quote, pretty good guess of what will happen if the economy behaves as expected. How did he do? Well, so far it looks like he did okay, at least in delivering a semi-hawkish message. Fed funds futures are trading just a touch higher, but they are still retaining that bias against any rate cuts this year. And that was perhaps the most important thing that Jay Powell wanted to accomplish today. Interestingly enough, though, Romaine, here's the thing that is somewhat surprising. It didn't take long. Powell was not even out of the chair when Austin Goolsbee, the Chicago Fed Bank president, was speaking. And he said, for me, the rate in pause this last week was a close call. He felt reconnaissance is perfectly appropriate after you've had 10 raises in a row, among the fastest in history. You know that it takes time for that to work its way through the economy, but he still sounds very dovish, and he was followed by the Atlanta Fed president, Raphael Bostic, who said, let restrictive policy work for a while because it's prudent. The policy has been truly restrictive for less than a year, and it takes time to influence economic activity. In other words, the two of them are talking about not raising rates the rest of the year, or at least not anytime soon. The other big thing that came up today was banking questions about what they're going to do about bank regulation in the wake of the bank failures. Powell said, we're waiting to hear from Vice Chairman Barr, and then we'll talk about it.
Interesting. Michael McKee there. Nice recap of what we heard today from the chairman of the Federal Reserve. Lara Rame joining us right now. She's FS Investments chief U.S. economist, who I'm sure was listening in as well as the Jay Powell spoke. Were you surprised at all by the fact that he stuck by his guns from what he said a week ago?
No, I don't think so. It's been so recent since the FOMC meeting. It makes sense that he's really going to reiterate this message. I think something that's important to remember is that, you know, back in early March, before the regional bank failures, the market was expecting the Fed to raise rates as high as 5.5 to 5 3/4. As those banking concerns have ebbed to a large degree, I think it's natural that markets and the Fed is starting to toy with the fact that given the economic data where it is, we may have to keep raising rates. The Bloomberg Economic Surprise Index is at an 18-month high. So, we see some of this complacency about the economy in equity prices. And at the end of the day, the economy still looks like it's really sailing along.
Well, that's what I'm curious about here, because, what data are we looking at here? Because I feel like you can cherry pick some data and say, okay, the economy's weakening, maybe we're headed towards a recession from those long and variable lags. And then there's so much other data you look at and you think, the economy looks pretty darn good.
You bring up an important point. You can't just look at the data. You need to look at where the data is coming in relative to what markets expect. And that has been a steady string of upside surprises. One area that has been consistently pessimistic is the business surveys. Things like the ISM, some of the regional manufacturing surveys have been really weak. But when you look at the actual activity and you look at the employment data, generally speaking, you're still seeing a really solid economy. And on the inflation side, we have to remember the Fed is going to continue to be focused on this. Listen, we've come a long way from 9 down to 5, but it's going to be a lot harder to get inflation from 5 down to 2. And I think that is what Powell is really stressing. The devil could really be in the details of those last 3%, even though it seems like we've come a really long way from the peak of the middle of last year.
So let's talk about this idea. We heard from Austin Goolsbee, as Michael McKee was talking about, as well as Raphael Bostic, which seemed to be making the case that maybe that sort of pause that we had at the last meeting could actually be it. There does seem to be a little bit less unanimity, if you will, if not in the vote, certainly in the discussion.
That is absolutely true. You're seeing that from, the guests that you're having on your show, from the markets, which are really wavering with these expectations. To me, I still think that there are more rate hikes left in this cycle. Our economy had a tremendous amount of momentum, and monetary policy impacts our economy differently than it has during prior rate hike cycles. So many people have low interest rate mortgages. Our economy is just a very different machine now than it was back in the mid-2000s. So I'm in the camp that thinks that they're going to have to go further, but it is a healthy debate. And at the end of the day, the bond market volatility, I think we're seeing some of that uncertainty about the final Fed rate hike weigh on markets. This is what is going to continue to give us some volatility.
All right, Laura, always great to catch up with you. We're going to have to leave it there. Laura Rame, she's FS Investments Chief U.S. Economist here as we keep our eyes on the Fed and Jay Powell. Coming up here, all eyes right now on the Hong Kong exchanges and clearing. I had a chance to sit down with the CEO of HKEX, Nicholas Aguzin, to talk about his plan to really expand the reach of the Hong Kong exchange, including opening an office right here in New York. That conversation coming up after the break. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The main exchange out of Hong Kong, Hong Kong Exchanges and Clearing, looking to expand its footprint outside of China, across the world, including a brand new office right here in New York City, the first office in North America for the company. I had a chance to sit down with the CEO of HKX, Nicholas Aguzin, earlier today to talk about the investment opportunities in China, as well as the investment opportunities coming out of China to the rest of the world. Take a listen.
If you look at the whole world today, the amount of investment in Asia and in China, because remember, Hong Kong is not just China. China, of course, is a place of competitive advantage for Hong Kong, but it's around all of Asia. The amount of investment is still very small. So the world is invested 1 to 2% of the total assets in the world are invested in China for an economy that represents 18% of the world. This is still early days. We expect that to grow massively. At the same time, we expect also that investors from the mainland will start investing overseas a lot more.
And they'll use Hong Kong as a conduit, because Hong Kong has for years, decades, really been that sort of gateway into China and really broader Asia as well for foreign investors. That's also going to be the gateway for mainland Chinese investors to find opportunities outside the mainland.
A few years ago, in 2014, we started building a special connectivity program that is called Stock Connect. That allows a very seamless, it's a very unique program that allows trading in Hong Kong and directly linked into the Shanghai Exchange and the Shenzhen Stock Exchange. That works both ways. We call it southbound and northbound. Both of those windows have been opened, and they've been growing and expanding very, very quickly.
Another milestone for the exchange this week was the beginning of a program that allows folks to make these investments, make these purchases in yuan denominations.
That's like a great point, because it's brand new. We started with this on Monday, and the purpose of this is that clearly people in the mainland, they have renminbi, yuan renminbi, but in Hong Kong we trade in Hong Kong dollars. Hong Kong dollars is tied to the US dollar. However, it was a little bit inconvenient for people from the mainland to actually invest when they have to transform it into Hong Kong dollars, and so that was a bit of an inconvenience. And so what we're doing is we're creating a mechanism by which we have two counters for each stock. It's traded in Hong Kong dollars and also in renminbi, in yuan, in offshore yuan. And this is important because, number one, it helps improve our position as a renminbi trading center in the world, a key renminbi trading center in the world. Number two, when that southbound flow can start trading in renminbi, which will happen, it's been announced and we're working on that, that will be a major thing, because it will facilitate that flow of Chinese investors investing in companies from anywhere around the world that trade in Hong Kong.
I have to ask you a little bit here about geopolitical issues here. When you travel around and you're talking to clients that are interested in investing, foreign clients, meaning non-China clients here, is there still a worry about some of the geopolitical issues and whether that becomes disruptive to the business process, to the investing process?
Politics around the world have also always, been a part of financial markets. I've been in the financial markets over 30 years, and I know firsthand that politics always has an influence into financial markets, and there's a linkage. So it's very difficult to isolate the political side or the geopolitics from what's happening in financial market. They do have an impact together with other global macro factors. So the investors definitely.
But part of that geopolitical concern out there is also one of transparency in the markets, and also, I guess, having some assurance here about the consistency in regulation and oversight by the government. There's been some concern that from day to day, from year to year, things can change, and investors get caught off guard by shifts in policy or just shifts in tone.
Yeah. What I can say is that from a Hong Kong point of view, there's been a lot of stability, a lot of resiliencies. The rules are very clear and transparent. If you look at, for example, the Fraser report from Canada, they rate Hong Kong as the freest economy in the world. I mean, number one. And so the tax rate is very low. I mean, Hong Kong has a lot of very unique things. Low tax rate of about 15%, free flow of capital, free flow of information, common law, I mean, great institution, great regulatory environment. All those things have not changed, and they have not changed for decades, and it's very permanent.
Nicholas Saguzan there, the executive director and CEO of the HKX, opening an office here in the United States as that company really tries to expand its footprint, providing, in his words, a gateway to mainland China and the companies and stocks that they have to offer. Meanwhile, back here in the U.S., an eye on the markets here. We are pretty much red across the board, but the good news is we're actually near the highs of the day here. The S&P is still deep in the red, down by about 0.1%. The NASDAQ down by about 0.8%, and you see some of those Chinese ADRs still on the back foot here. But some of the dour sentiment that we had coming into today has reversed just a little bit as we inch closer to these closing bells. Just about an hour and a half to go here as folks start to assess valuations, but more importantly, assess monetary policy, assess economic conditions, and then more importantly, assess some of those multiples. We'll be back in a moment from New York. This is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports. On the next episode of The Circuit.
So yeah, here we are at Dolores Park.
I mean, you've been doing this like 15 years.
Yeah.
15 years, that's a long time.
This is a long time.
Does it ever
for tech standards?
Does it ever get like lonely at the top?
Oh yeah. You can have all the money in the world, all the success in the world, but the thing that makes most people happy is just connections and relationships.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
This is Bloomberg Markets to Close, almost 2:30 here in New York. Time to get a check on what's happening in the commodity space. Abigail Doolittle standing by right now with our commodity close. Abigail.
Well, we do have a bit of a rally, Romaine, and the Bloomberg Dollar Index is down, so that's one overall driving factor to the upside. But you can see it's really broad-based strength here. The New York crude is up 2% here at the close. Natural gas up 4.2%. But I really want to focus in on these grains, Romaine. On fire, wheat up 5.5%, corn up 5.4%, and apparently it has to do, especially with corn, the persistently dry weather. It's throwing the corn market off by the most in 3 or 4 decades. That seems to be helping out wheat. Wheat having its best day in fact since September of 2020. So anyway you take a look at this, we have big gains, but it's in contrast to the big losses we had yesterday. So stocks still trying to decide whether or not they're going to go higher on the day. Commodities clearly going in that direction.
All right, Abigail Doolittle there. We're going to stick with commodities. Our next guest says there's going to be a huge bifurcation in the crude market, and it's really driving a lot of problems. Greg Sher now, he's PIMCO's Commodities and Real Assets Portfolio Manager, joining us right now to explain. And Greg, explain.
Yeah, so I think the main thing that's been challenging to the oil market right now is we've seen distinct weakness in the very light end of the barrel, the liquefied petroleum gases, ethane, propane, butane, even naphtha, which are heavily dependent on the manufacturing petrochemical cycle. In contrast to that, we've seen the reopening of the Asian markets, China in particular, which is leading to service-related demand growth in jet fuel, diesel, and gasoline, and we've had a pretty big bifurcation. The light end weight, though, is really showing up in pressure on the very light end crude oils, which has actually been the crude oil that we've been able to grow globally, in part because of the growth in the U.S. production. In contrast, much like in the bifurcation of refined products, we've seen a reduction in the medium and sour crude oils that key OPEC producers export. So we've seen this growing detachment between different parts of the barrel that I think has been sending conflicting signals to the oil market. In my view, if we see it, sorry?
I'm sorry to interrupt, but I'm curious if you just could kind of explain, though, sort of, I mean, what kind of drove that bifurcation, though? I mean, I know some of it probably had to do with the war in Ukraine and then the sanctions on Russia, but were there other factors as well?
Well, there's been a real turn down in the energy-intensive industries in Europe in particular, where we have seen, if you look at the IP indices, the new order indices, you actually back out industrial demand from looking at daily pipeline consumption statistics. We have not seen any rebound in European energy-intensive demand. That has led to a depressing force on petrochemicals, and petrochemicals really is the linchpin for a lot of these lighter molecules and drive a lot of the demand for them. So if you have a weak manufacturing and durable goods cycle, that's where the weight is most pronounced, and I think that's the primary driver of that challenge in that end of the market.
So for those of us, Greg, who don't know this industry as well as you do, we look, of course, a lot of times to crude products, to energy products overall, as kind of a barometer for economic conditions. As a barometer, what is it actually telling us about economic conditions?
Well, it says the service sector is doing quite well. If you look at the strength in the diesel markets, you look at strength in gasoline markets, you look at jet, we've seen a real turn up in demand. You know, if you look at 2023 demand estimates today versus 6 months ago, the demand estimates are 400,000 to 500,000 barrels per day higher. That's like 0.75% GDP increase if you think about it in those terms. So that's real strength. But there is real weakness in the manufacturing sector, and there's real weakness in the petrochemicals, and that's undeniable. So it really is a very much a split picture, and I think the thing that would really be a catalyst for higher prices in oil is if we do see the manufacturing demand, the petrochemical demand turn higher.
I want to get your thoughts here, Greg, on some other areas of the commodity space, specifically when it comes to agriculture. Abigail Doolittle was mentioning some of the price movements we've been seeing in corn, looking at crop conditions, kind of the worst I think we've seen going back to the 90s right now.
I mean, the market was fairly complacent with the starting conditions with low inventories for many row crops already. Heading into this growing season, that if we did not have a good one, we potentially would see a meaningful rise in prices again. Now, it's still too early to call the growing season at a purely distressed point. There is time for rains to catch up, but it needs to happen. If it doesn't, then we have low inventories, and that's going to be an upward pressure on prices, and that's hard given the starting conditions of where we've been with several years now of poor crops. And when we look at Europe and we look at Canada today, for example, they're also in a very similar position as the U.S. is.
Do you see any hope here of a rebuilding of some of the inventories in the agriculture space?
Our baseline was for that, for sure, and still is. Export demand has been low. We've not seen strong demand for corn, for example. So we do think we will be rebuilding inventories, but that is really dependent on yields sustaining themselves and the U.S. Getting some rains.
All right, Greg, great stuff. I really appreciate you taking time for us. Greg Scherer now there. He's PIMCO's Commodities and Real Assets Portfolio Manager. A look here at what's been going on in the commodity space. Coming up after the break, a look at what's been going on in the home builder space. We know that whole sector, at least for new homes, has been on fire, and KB Home expected to report earnings after the bell. Expectations have been high on signals of strong demand from that industry continuing. We're going to have more on what to expect when we get those earnings after the bell tonight. Stick with us. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Daybreak Europe. Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
right, time now for our top calls, a special AI edition. The big movers on the back of analyst recommendations, and we start off with Adobe. The software company upgraded, well, to outperform at BMO Capital. The catalyst, the addition of generative AI to its suite of products. The analyst lifting the price target to $570 from $500. Says as long as users are willing to pay for more of Adobe's new solutions, AI can be the big driver of revenue and growth. Nevertheless, Adobe shares down about 1.5% on the day. Next up, Tesla also getting cut down to equal weight over at Barclays. Analyst Dan Levy saying that the shares have rallied too far, too fast. Says the AI narrative on this stock a bit overdone. He also questions about the electric car maker's near-term fundamentals. Nevertheless, he did bump up that price target to $260 from $220, but that was primarily to reflect a broader increase in the multiples that the firm has for a 2030 scenario. Shares of Tesla, which have been on a tear, giving back some of that, down about 4% on the day. And finally, let's take a look at Coherent. The semiconductor and laser device company cut to neutral over at Rosenblatt, with the analyst saying that the bull thesis on AI may be ahead of itself for the stock. And while Coherent will benefit from the technology, long-term concerns, they still are out there. Coherent having an awful day, down 14% on the day, and those are some of our top calls. We want to stick on the sell side right now and make a pivot to housing. No idea if it's going to have anything to do with AI, but of course, this industry has been on fire. KB Home expected to report earnings after the bell. The expectation is for deliveries in the second quarter to be about just under 3,000 for the quarter. Jay McCandless is joining us right now. He's Wedbush Securities Senior Vice President of Equity Research. He has outperformed on the shares and recently boosted his price target up to about $55. All right, Jay, let's start off with deliveries here. We know that for most of these home builders, including KB Home, they've been relatively strong. You expect that to continue beyond just the second quarter?
Yeah, we do. So deliveries, we are over 3,000 and ahead of consensus at roughly 2,800. We do think that's going to push earnings up to $1.34, which is 3 cents ahead. I think the more interesting story here is going to be what orders look like in the back half of fiscal 23. Last year at this time, everyone knows what happened at the back half of 22 with rates moving up, demand drying up, created some pretty easy year-over-year compares for orders for KB and for the rest of the group. So in addition to what we're expecting for the second quarter earnings, we also talked in our preview note about how we do expect some pretty easy comparisons in the back half of the year, and we think that should help push these shares higher.
I am curious. I mean, last week when Lennar reported, I was listening to some of the commentary from the executives there, Jay. They were asked a lot, of course, about prices, home prices itself, and I believe the money quote there was effectively that prices had bottomed. I'm paraphrasing a bit, but that was the sentiment coming out of Lennar. Are you seeing that type of sentiment widespread across the new home builder space?
Yeah, it seems there's still, I think, a couple problem markets where the builders are having to move down base pricing, but by and large, base pricing seems to have stabilized, if not moving up again. I think that's what we're going to hear from KB tonight. You know, again, there's certain markets, the Phoenixes and the Denvers of the world that may be still a little behind, but the Southeast, Texas, especially ex-Austin, seem to all be doing very well. And if you look at the macro data that we've already seen this week, the builder index came out ahead of expectations. Start certainly came out yesterday ahead of expectations. So it seems like housing demand for both multifamily and single family is starting to pick up again.
Is KB, geographically speaking, Jay, better positioned for that than others?
They have about a 40%-ish exposure to California. They've been bringing that down over the last couple of years, but they do have good exposure in the Southeast and Florida, Texas, in these larger markets where you have seen was COVID migration, and now I think there's some tax migration in there, but that's still a catalyst for the group. Yes, but from a geographic perspective, we think they have good exposure to multiple markets.
When we talk about what we can expect, not only out of the earnings statement, but what you want to hear off the call. I mean, when we got Lennar, not to draw too many comparisons to Lennar last week, but it wasn't just the results that they gave for the quarter, but raising the guidance going forward seemed to be a pretty strong indication of how these CEOs, how these executives view the market right now.
Agreed. And, you know, when they gave us the updated guidance, I think we all expected higher volume, which they gave us. But what I think was unexpected was their good news and I think good outlook for, or better than expected outlook for gross margins.